view is that the Fed probably is done.
For the Fed, yes, the bar is high for another hike.
We will get a period of slower growth, but that's not surprising.
There's disinflation in the U.S. economy, and we're heading back to 2%.
The question is, how long does it take to get back to that 2% inflation threshold? And I think in that context, we have to have patience.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
What a 24 hours in this market. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Your equity market on the S&P 500 positive once again. TK yesterday, that was the sound of a declaration of victory over inflation in financial markets.
It wasn't transitory. It happened right away there at 8:30 with the shock CPI report and the nuances of it. And John, I can honestly say, as Lisa and I tackled it, you were off on your break with your interns, but Lisa and I at 8:35, at 8:45, at 8:50, it just kept coming on. Here's the statement. I've never seen it before.
I was logged onto the Bloomberg for the close, TK. Best day of gains on the S&P 500 since April. Small caps up more than 5%. Best day this year. S&P 500 real estate, best day this year. Nvidia up for 10 consecutive sessions. Bramo, the moves we saw yesterday, I think we've got to remember this, off the back of the smallest of downside surprises on inflation.
That is an important clarification. A 0.1 percentage point difference in the inflation rate that people were expecting versus the one that they got. You could make all sorts of other excuses, like the whisper number was higher. Nonetheless, to declare we've done it, we've got victory, we actually have won against the fight of inflation on the heels of a downside surprise like that tells you what people want and how much the narrative is shifting, regardless of whether it sticks.
Yeah, I don't think the Fed's going to jump on board just yet, TK. I heard that a lot yesterday. It is too premature for this Federal Reserve to do the same thing.
Really strong. I mean, a major shout at Jason Furman, teaching all of us besides Ec 10 at Harvard. He did great analysis, along with others, of 3-month annualized, 6-month annualized, some really complex formulas that are, okay, what is the total picture? And instead of saying mission accomplished, and I teased people with that knowing it's not, the question is the vectors in place. This really accentuates the disinflationary trend.
There's so much happy talk, it's overwhelming.
Yeah.
Neil Dutter of Renaissance Macro capturing this perfectly in this quote yesterday. The inflation data, Bramo, soft landing nirvana for equity markets.
It was nirvana if you take a look at all of the internals, too, because not only did you get serious disinflation, outright deflation, even in things like airplane tickets, which people weren't expecting, but you also had real wages increasing. So basically, the consumer picture was actually doing better at a time when you did see disinflation continuing to accelerate. Tom?
Was Nirvana a band?
Nirvana was a band, yeah.
Oh,
It was also a band. Good band too, Tom.
Okay, I got that.
like
Early mid-90s.
Yeah.
Yeah, your kind of music.
What about more? We got more of an add-on here, and it's into the end of the year. Ben Laidler out with a note saying, guess what? 1/5 of returns, historically, 1/5 of returns come in December.
David Costin, Goldman Sachs, out with the outlook. Do you want the number? 4,700 year-end next year. Not far away from where we are right now. Here's the line that I think matters because they're really constructive on the economy in 2024. The current starting point will limit the potential appreciation for the benchmark US equity index in 2024. Our economists forecast above consensus GDP growth for next year. But Lisa, this view is already reflected in equity prices. So take all the happy talk of the last 3 minutes. Have we already discounted it, Bramo, in markets?
And so, in other words, you could get sort of a tepid year of gains. Increasingly, though, our conversations are a lot more nuanced about where the gains are going to come from. And that's why I thought that the small cap move yesterday was so interesting. It was the biggest gain in almost a year. And it really comes in the heels of everyone saying we like it, but we can't really bank on it because we've been burned again and again and again. So at what point does this actually lead to some normalization in terms of correlations in a way that sort of belies the meager gains that implies?
This move yesterday was the definition of an everything rally. The equity market move continues this morning on the S&P up by 1/3%. Equity futures pushing higher. Bond markets yesterday, double-digit moves on yields lower across the whole curve. 2s out to 30s. This morning, we're up a couple of basis points, but Lisa, still south of 450. Your yield this morning, 447.
Ira Jersey yesterday of Bloomberg Intelligence was talking about the lack of liquidity and the violent moves. And again, do we get a sense of stability, or is this just a rally with a new narrative shift that's going to, portend another narrative shift down the line? 8:30 a.m. U.S. retail sales and PPI data comes out. Will PPI confirm what we saw yesterday? with that CPI print. Retail sales, really important. We kept hearing that from guest after guest yesterday. Do we see a deceleration after last month's surprise 0.7% gain month over month, year over year? We have sort of normalized, even with inflation baked in.
What's good for the market today in retail sales? Is like good retail sales good, or is bad retail sales good? Are
you the one asking if good news is good news this morning?
Well, after yesterday, I'm like, okay,
is that what you're asking?
What do I want in retail sales at 8:30?
I think based on current disinflationary trends, any signs of decent output, Bramo, is good news, because a lot of people at the moment seem to be shaking off the threat of that transpiring turning into higher inflation anytime soon.
I just am thinking about Stuart Kaiser screaming at his television right now, saying good news is good news, period, full stop, and this is what we want. Today we also get the color commentary from some of the big retailers, 6:30 a.m., about a half an hour. Target comes out with earnings, 7:30 a.m., TJ Maxx. What I'm curious about is how much do we see, Target reaping the benefits of some of their cost cutting. TJ Maxx would be interesting. Discounters, are they getting attention as consumers cut back around the margins? And today, the APEC summit is taking place, headlined by Xi Jinping and Joe Biden. They're meeting this afternoon. You can expect photos and handshakes and press conferences, I believe. But this actually might be more interesting. At 10:30 p.m. Eastern, Xi Jinping is going to headline this dinner with the CEOs. He's increasingly looking for business diplomacy. How much can he really offer some of these executives to give them confidence?
Is In-N-Out catering?
AMH with big reporting. AMH with big reporting in the last 12 hours. Secretary Yellen in and out.
Did you see all those executives with their little...
We've got the order, TK. Cheeseburger with onions, fries, and a Diet Coke.
That's like all she's missing is a tang.
On the way to the airport.
I'm so judgy of Diet Coke drinkers. I don't know why. I don't know why.
It's a British thing, Lisa.
I don't get it.
So now you have a totally different view of Janet Yellen?
Diet soda.
Most people thought that it was a pretty baller move of her to do that.
There's nothing baller about Diet Coke.
No, not that. Of going to In-N-Out on the way to the airport to pick up Xi Jinping. It's just very kind of,
Could you see Steve Mnuchin in In-N-Out? Pick it up.
No, I can't.
He goes, wait, can I buy this place?
Should buy this place. Great burgers there.
Oh, thank you.
Fantastic. Ben Gutteridge joins us now, Investment Director at Invesco Investment Solutions, wondering where this conversation is going. Ben, we're going to talk about markets, don't worry. Soft landing nirvana for the equity market. That's what Neil Dutta of Renmax said yesterday. Is this soft landing nirvana for the equity market?
Well, I mean, it's certainly, Goldilocks overtures, whatever fairy tale spin you want to put on it. But yeah, the combination of forces are quite rightly lifting equity markets and sentiment, fading inflationary pressure, resilient growth, rate hikes in the rear view mirror after a troubling, post-summer period. I think, clearly markets can give a little bit back after such euphoric gains, though not today. No, I think there's nothing irrational, I don't think, about how the market's performing of late.
Ben, you've been a real student of these markets. To me, it screams second leg of a bull market. Like there's a malaise of 76 into 77, and then boom, second leg of a bull market. Does this feel second leg off the October lows 13 months ago?
Well, I wouldn't. Perhaps I'm evoking too much enthusiasm here. I certainly think there's gains to go for at this stage. As I said, that resilient growth story can run. I don't think a recessionary threat is immediate as we look to the first half of next year. And as I said, with rate hikes in seemingly behind us, that can support momentum, along with like a reasonable amount of cash on the sidelines looking for a home. But I wouldn't want to lose sight of the severity and pace of interest rate hikes that we've seen. I think recessionary risks are material for sort of the second half of next year. So, want to enjoy the spoils of market momentum, but have to be thoughtful about when to pivot to get a little bit more defensive. So couldn't quite get on board the idea that this is sort of the start of a sort of second bull market, as you put it.
Yeah, I look, Ben, at the second bull market and the sectors here and just observing it. Do you see breadth in this move? I mean, a shock move off one inflation report. Is there going to be a new breadth out of this globally?
Yeah, I would suggest, probably more breadth outside of, US large caps, though we do believe they should continue to enjoy positive momentum, but just as we saw in US small caps and actually sort of slightly better data internationally, be it, some European survey data about where growth is going, it wouldn't be quite such a concentrated area of gain. So, international exposure, slightly more value, slightly more small cap exposure, looks like a reasonable trade into year end. But you've got to be nimble to take those. I mean, actually, in our sort of portfolios, reluctant to be quite so tactical, and do find some comfort in US large caps to be able to enjoy gains at this moment, but also be there to cushion some of the blow from losses that might materialize in the face of a recession next year. But the shorter term trade, I think, is breadth, small caps, value, and international away from US.
So, Ben, I'm still stuck on the poetry that you uttered. Enjoy the spoils of market momentum, and you talk about being nimble. And it sounds wonderful, like going to a party and eating until it's done. How do you know when it's done, and what does it mean to remain nimble and enjoy spoils of something you know is soon to end?
I'm clearly just so bought into and caught up in the euphoria of market moves. I must be giddy in my communication. But look, I think... because of market momentum, because growth is looking resilient, and maybe there is something of a manufacturing recovery, like the destocking cycle that we've seen, running down inventories, that looks like it might have run its course. And with, as I reiterate, with rate hikes in the rearview mirror, there's a lot of reasons to be positive. And so with cash on the sidelines, I think the breadth is a natural outcome of increased optimism, and I think this can run into the end of the year. But as I sort of said, if you can make trades for sort of 2 months at a time, it's worth going for. But if you're slightly more cautious in your execution and are alert to the risks of recession as they build, I think, through next year, then maybe more resilient assets such as US large caps you might be better off just sort of sitting there and enjoying perhaps less relative gains in the short term, but less volatility as well.
Hey, Ben, thank you. Ben Gunridge there of Invesco Investment Solutions on his latest views in this market after a stellar move yesterday. What do we all think of lyrics and Southside Research? What do you think about that, TK? This from David Costin. Follow Taylor Swift's advice in the song from her 1989 album, All You Had to Do Was Stay Invested. Does that work for you? I'm not big on this stuff.
I'm
not big on this stuff.
Well, Costin's brilliant,
Buscemi's, kids.
I feel like that was almost like a bet that he had to get it in there, because ultimately they're only looking for that much upside anyway. So does it work?
We're talking about it. So isn't that working?
Sure.
And how do you make something more entertaining?
Well said, Bramo. Well said. I am talking about the note from Costin. Yeah. There's a whole bunch of reasons why they do think there's limited upside here, and it's worth going through them, Tom. The above consensus GDP growth story that they're looking for in 2024, Costin says, is already reflected in equity prices. Margins have stabilised, but substantial expansion from current elevated levels appears unlikely. He thinks that we're fairly valued at the moment. Even if the Fed has finished its hiking cycle, they will remain on hold until Q4 2024. TK, that is the Goldman view.
What are we going to see here into the weekend? We're going to see it here, John. SPX up 0.3%. And guess what I'd like to see? I'd like to see a lot of people, including me. Humility is in order. And Dennis Gartman, for 30 years, has led the way with candor when he's wrong. I talked to him the other day, John, and Dennis Gartman just said, Tom, I flat out got this wrong. We need a lot more of that.
Lots of people got this year wrong. Yeah. So I wonder how they're thinking about next year and what they think the biggest risk is. Is it that we get a material weakening in this economy, or does this expansion just persist in a way that's unexpected and it doesn't lead to rate cuts in 24? Much more on that in just a moment. Equity futures right now still positive on the S&P 500 after a monster day of gains in yesterday's session. From New York City this morning, good morning.
When it comes to government funding, as I have long said, it has to be bipartisan. And right now, that's the path we seem to be on.
We are not going to have a massive omnibus spending bill right before Christmas. That is a gift to the American people, because that is no way to legislate. We've gotten together. I believe there's going to be bipartisan agreement on that to break it up.
That was Senate Majority Leader Chuck Schumer, House Speaker Mike Johnson speaking just hours before a bipartisan vote in the House passing a stopgap funding bill that would avoid a potential government shutdown. That bill now moves to the Senate. So, TK, here's the good news. We might deal with this week. Here's the bad news. We're going to deal with it a few times going into New Year, TK. This story's not going away.
Yeah,
this story's not going away.
It's not going away, and it's sort of pretty tragic. And what gets me going, you know, I'm somewhat of a student of this. As you look at some of the charts out on Twitter, and again, I can say I've never seen these charts, like the amount of interest we're paying 1 year, 2 year.
The market loves a can kick.
Global interest payment.
That's great news. We don't have to deal with it going into Christmas, and maybe we can open the door to a bigger Santa rally into year end. Your equity market's just flying over the last 24 hours, up a third of 1% this morning on the S&P 500. Yields aggressively lower across the curve yesterday. 2-year out to 30-year bonds. The 10-year maturity yields higher, Tom, by a couple of basis points. It doesn't matter what I say right now, does it? You're just going to talk over me and say something different.
I mean,
can I just finish on the yield and the 10-year? Is that all right?
Please.
Just see if you can allow me to speak without saying yeah 5 times.
Yeah.
447.26 on a 10-year. Go.
Market drawdown. Back to when I went to cash.
It had nothing to do with bonds. I knew
2021. John, look how the NASDAQ has made up. Look how the NASDAQ has caught up so quickly in the last month. SPX, -6. Drawdown. Dow, only -5. NASDAQ, I was stunned. I thought it'd be like -11. -4%. That's how fast we've come back.
It's amazing.
It's amazing. No idea. Continue.
No, I'm done.
Okay.
I'm so done.
Right now, we are never done with Maya McGinnis, president of the Committee for a Responsible Federal Budget, for 2 reasons. The federal budget's not going away, our debt and our deficit. And just importantly, Maya was an 8th Dan or a 9th Dan in judo, and she's now up to 10th Dan, so she can self-defend herself in our fractious Washington. Maya, in all your years in Washington, have you ever seen it so violently polarized?
Oh, absolutely not. I mean, what's going on right now, I think about this a lot because this is a moment where we are so distracted with our infighting in Washington. We are absolutely missing the big picture of what's going on externally. And there are external threats from rivals around the world that should be unifying us and helping us function. And I fear it leaves us in an immensely vulnerable place. So we have these huge parallel risks here, which is our fiscal situation leaves us really vulnerable, and our political situation leaves us really vulnerable. And the noteworthy thing is now it's within the parties, not just between the parties.
Explain to all of our listeners and viewers the one item that's front and center, which is our rising interest expense. Translate how we should interpret, as a round number, a $1 trillion government interest expense.
It is a bright, flashing warning sign that the U.S. fiscal situation is unsustainable. So $1 trillion in interest is sort of shocking, but absolutely sort of predictable because we're borrowing so much every year and it's getting worse even when the economy is so strong. Interest is the fastest growing part of the federal budget, eclipsing healthcare that was for quite some time. We spend more on interest payments than we do on all spending for children under 18 at the federal level. And within just a few years, we're going to be spending more on interest than we are in national defense. Clearly, it's squeezing out all these important priorities. Whatever your particular ideology is, there's not going to be as much money for it because interest comes first. And just let's keep in mind that when interest rates were low, there were all sorts of people saying, borrow more. It's almost like it's free. It's not. It wasn't. And this is the moment where it shows you that if and when interest rates go up, and they almost always do, the huge debt load that you have as a result of people encouraging to borrow more leaves you immensely vulnerable and squeezes out other priorities, both investments, national security, and anything else that we might want to be spending or preparing for.
Yesterday, money got a little bit more free, or at least a little less expensive. How much of a bond rally are we away from being sustainable on a fiscal picture?
It's not coming from a bond rally. It's coming from changes to the structural budget situation. So the markets can do whatever they are. I mean, when interest payments weren't the fastest area in the budget, that was a big relief. It took some pressure off. But listen, you still have huge growth in spending from the aging of the population and ongoing healthcare costs. So Social Security and Medicare are going to continue to grow much faster than the overall economy. Revenues are not going to keep up with it unless our policymakers do something. And I know that that feels kind of difficult to imagine right now, but unless they do something hard, which is look at the real budget, the entitlements and the tax side, and make some changes, this unsustainable separation between the two and growing deficit and debt is going to continue.
You talk about how, based on how things are going, it doesn't seem like they're actually going to do anything. We're more focused on Elbowgate with Kevin McCarthy yesterday in the House than we are on tangible gains with respect to reducing the deficit. Do you feel like you're banging your head against the wall when you talk to the different Congress members and try to get them to hook into more sustainable solutions?
You know, I don't right now, because there's been a very, very encouraging sign both in the House and the Senate in a bipartisan effort, which is to put together a fiscal commission. And what the commission would do is look at all these parts of the budget over the next year. It's no guarantee it works. It's still really hard choices, and Congress doesn't like to do anything difficult right now. What they like to do is cut taxes and grow spending and give away things. But the benefit of a commission is it gives members a chance to actually build a working relationship where it doesn't come to blows, build trust, understand the issue better, and give some political cover if they come up with recommendations to be adopted. Right. One great thing would be if they could come up with a Social Security fix, given that that program is headed towards insolvency in about a decade.
How close are we to another Simpson-Bowles effort?
So, as I said, it's bipartisan, bicameral. That's a great start, but there's already lots of opposition for no reason but political. I don't know how you can look at a program that's headed towards insolvency and say, hey, stop, don't try to fix it. But that's what a lot of people are saying. You're hearing from the White House criticisms about the notion of a fiscal commission. All sorts of people, I think, want to politicize these issues. But overall, I think there is broad-based support, and I think it's growing. And basically what I see is at the end of the year, we are going to have a lot of borrowing for emergencies and legitimate emergencies, perhaps also some tax cuts that should be offset. They're talking about a deal where you would extend some business tax cuts in return for the child tax credit. That's a borrowing deal and a borrowing deal. But if they do end up borrowing a lot more, I think this clamor for doing something, and the fiscal commission as the best mechanism to do it, is only going to grow. So I could see that being part of a deal at some point soon. They're going to have to do something. The warnings from, rating agencies and the Congressional Budget Office, they're just going to keep coming.
Big time. Maya, thank you for your perspective this morning. Maya McGuinness there of the Committee for a Responsible Federal Budget. There is a big battle over spending on the horizon. Maya mentioned the credit rating agencies. Let's go to Moody's and what they had to say going into the weekend. Federal interest payments relative to revenue. This is what they expect in 2033, 10 years from now. That's going to climb to 26% from 9.7 in 2022. Tom, that is a huge number.
And that's why it's so important to listen to people like Maya McGuinness, because I think on this topic, it's not that there's bad information or false information. There's just a jumble of stuff that's a blur to us. And the clarity, like what you just said, John, on 26% clears the mind.
Yeah, the details of how to fix Social Security don't gather the headlines of a fistfight or an elbowing, and it's harder to parse through all of that in a granular way on morning television. And so at a certain point, people gravitate to these other sort of posturing stories in a much more significant way, and that's what politicians follow to generate support. How much can we really get something done? What she was saying, a commission, something that can actually be divorced from the sort of partisan politics, has to be the way to go.
You think that's possible?
No.
Isn't that a problem?
I hope so, because at a certain point, it does become unsustainable. And we are seeing reactions in markets.
What does a 125 sterling do to people in the United Kingdom? That's a move.
That's a change of course.
Off the weak dollar. No, it's not. I mean, everything's a jumble off of yesterday, including 109 euro in a 125 sterling. I mean, that's almost a shock number.
I love the inflation print in the UK today. I think it came in at something like the lowest in 2 years.
Yeah.
Real big pullback year over year. Yeah, Rishi Sunak, the Prime Minister, coming out and trying to take some credit for that, which I thought was slightly humorous. Coming up very shortly, Bruce Kasman of JP Morgan's going to weigh in on some of this mess. Equity futures right now. This ain't a mess. What a move in the last 24 hours. Big move high yesterday, inching high today. Equities up 1/3%. Fight Club in DC up next. All it took was a small downside surprise on inflation and boom, this equity market spiking higher and rallying aggressively into the close. Equity futures right now positive 1/3% this morning. The Nasdaq up by 0.5%. Yesterday, the best day of gains on the S&P since April. Small caps, the Russell, up another 0.5% this morning. Up more than 5% yesterday, Bramo, for the best day of 2023.
Markets were in search of a narrative that could give them more optimism. They found one yesterday, and essentially you saw them lean into it. And that was the rally that I felt, not necessarily even looking back to see whether it was true or not. It didn't matter because you can enjoy the spoils for now, as we were hearing earlier today.
Every single sector in the green at the close on the S&P 500, as we've said a few times already this morning, the very definition of an everything rally across the equity market and in the bond market as well. 2-year, 10-year, 30-year. Double-digit moves right across the curve, yields lower. This morning a little bit higher on a 10-year by a couple of basis points, but we are sub 450 on a 10-year, Tom. 446.68.
Yeah, the bond shift is justified. I'm waiting for the 10-year yield to be quoted. I don't see it yet. 2.17%. We'll see how that goes. Anything under 2% is confirming and a shock. But to me, John, the arch battle forward, December and into Q1 next year, is the breadth of the market. There's a bet by some that breadth will come in and join the Magnificent Seven. There's others that say flat out no, stay on this. And there's still others that just refuse to participate.
It's a multi-part act this week. Let's be clear about that. We've had CPI. You'll get retail sales in about 2 hours' time. We'll hear from the retailers as well. Yesterday we heard from Home Depot. Bramo, right now hearing from Target. Third quarter adjusted EPS 210. The estimate, I believe, 147.
Yeah, comparative sales coming in less bad than expected, down 4.9% versus the expectation of 5.2%. Interesting that they cleared about 14% a lower level of inventory. So they're clearly working down some of those problems. Target shares up almost 7% in pre-market trading, but this is off of a really rough year, down more than 20% so far year to date.
Consumer discretionary had a good day yesterday, right?
Yes, it did.
Just kind of unlock this idea that maybe we can reduce rates, take some weight off the consumer, inflation's lower as well. We're going to spend big time into year end. Is that the story?
I mean, maybe I will on refrigerators, but it seems like people are being more discretionary, which is the reason why actually some of the commentary from the retailers and retail sales in 2 hours' time might portray a somewhat more nuanced picture than the runaway excitement that we saw yesterday.
That's Target. The stock is up by 5.9%. Tomorrow, I believe, we hear from Walmart, Macy's, and the Gap. Looking forward to coverage of that over the next 24 hours. Under surveillance this morning, China's Xi Jinping arriving in San Francisco for a high-stakes meeting with Joe Biden in his first trip to the US in 6 years. The two leaders expected to meet at 11 a.m. local time and discuss key issues including economic competition and military communication, along with artificial intelligence, the status of Taiwan, and conflicts involving Ukraine and Israel. Sources also telling Bloomberg, Tom, that Chinese officials are likely to seek a rollback on export controls, tariffs, and restrictions on investment in the United States.
We're going to ask for one thing, and we're going to give up another. I saw an interesting couple sentences of speculation about what America would do with human rights. But to your point, John, on tariffs, maybe that's a surprise here in that the tariffs that were wrought over the last 5 years begin to be discussed, or dare I say, even dropped.
I think this is about dialing back the thermostat at this meeting.
Oh, much
Tom.
better.
Yeah,
much,
not about big policy shifts.
It's not a wonk meeting.
No, for this market though, Peter Chia, Academy Securities, had this to say in his note that he put out yesterday afternoon. Be prepared for the meeting this week to come across as highly conciliatory, prompting an everything rally into year end, Lisa. We don't even need to see concrete actions taken. If the messaging is strong, that messaging should be enough to get the job done. And that's kind of what people are expecting this week, right, over the next couple of days.
Pick your reason. The rally will continue. That seems to be the sort of theme from Wall Street. I will say, in terms of the conciliatory tone, Xi Jinping was talking about Taiwan and having more of a closer business relationship with that region, which again is a softening in tone. It all goes to that mood music that you're talking about.
Let's go to the mood music in Washington, improving just a little bit. House lawmakers voting to pass a temporary stopgap government funding bill, greatly lowering the risk of a shutdown. House Democrats bailing out newly elected House Speaker Mike Johnson to pass the legislation, with 209 Democrats joining 127 Republicans in support of the measure. The legislation now goes to the Senate, where majority Democrats are expected to back it, even though it doesn't include aid for Ukraine or Israel. So it sounds like happy families down in Washington, D.C. It was anything but elsewhere on Capitol Hill. A congressional hearing on labor coming close to a full-blown fist fight. Tensions boiling over between senators and a witness. Oklahoma Senator Mark Wayne Mullen, who's a former mixed martial arts fighter, losing patience as he read aloud a hostile Twitter interaction between himself and the witness, Teamsters President Sean O'Brien. It took 82-year-old Senator Bernie Sanders to come between them.
Sir, this is a time, this is a place. If you want to run your mouth, we can be two consenting adults. We can finish it here.
Okay, that's fine. Perfect.
You want to do it now?
I'd love to do it right now.
Well, stand your butt up then.
You stand your butt up.
Oh, hold on.
Big guy.
Oh, stop it.
Is that your solution every polling?
No, sit down.
Sit down.
Okay. You're a United States Senator.
You're an embarrassment. You're an embarrassment.
Look,
after an embarrassment to the state of
this hearing is about the condition of the working class in America. That's what we're talking about.
You're the biggest thug here.
Absolutely lost for words. The first time I saw that video yesterday, I thought it was a spoof, Bramo.
I said it
had to watch it again.
Exactly.
I had to watch it twice, 3 times, 4 times. Couldn't stop watching. Absolutely ridiculous what is taking place in Washington.
My favorite is Bernie Sanders with the gavel being like, would you guys quit it? Just stop it.
There were some very funny moments in that hearing. What's funny about the whole thing, though, is no one really knows what that hearing was about. All we've walked away from is with those images, Lisa.
Well, but this is the issue, and not to be serious, but there is this feeling that that's what's going to catch everyone's attention, that from that House resolution that passed, we're going to be talking about Kevin McCarthy possibly elbowing another Republican Congress member. We're not talking about the substance and how much is that the Bernie Sanders, what he's fighting against, and he's kind of fighting an uphill battle because this is made for TV.
Maybe we thought it was over and made for TV, and I do take your point, Lisa, that this is playing for the local constituencies, who's ever involved. But this goes back. Think of the movie Lincoln, Daniel Day-Lewis, Sally Field. Charles Sumner's in the movie, and the most famous event in Congress was the caning. They all used to walk around, like John, like you walk around with the cane, you know, the London cane. The caning of Charles Sumner years ago. There's a history of this in Washington.
The senator that we're talking about that was included in that interaction actually referenced what you're talking about.
Oh, did he? I missed that.
Later on in media.
Later on,
excuse me. Had a conversation about that,
I just, you know, it's really, really sad. I was on the phone yesterday with someone in Washington, and they were almost crestfallen about it. You know, it's like, we're not supposed to do this. Do they do this in London? I mean, every time I've been to House of Commons, it's like convivial.
I think we stopped caning each other a while ago, Tom.
Yeah, thank you.
Yeah, I'm not sure anyone wants that back either.
We don't cane economists either, so he'll stay with us. Bruce Kasdan with a brief this morning. In these extraordinary times, chief economist, head of global economic research at J.P. Morgan. Bruce, it's a time to reset for 2024. A lot of us would suggest we got wrong 2023, and to me it centers around productivity. Austin Goolsbee of Chicago talked yesterday about a productivity that is a mystery, that's out there. Are all these good feelings happening because finally we have a new level of productivity in America?
I think it's a little early to say, but the news has been good. We've been running over the last 4 quarters a little over 2% on productivity gains. That's almost a percentage point above what we averaged the last cycle. Some of that comes because we've had strong growth, but there's been pretty solid investment for some time in intellectual property and R&D. There's certainly a case to be made here that we're getting some improvement. And I just would note that the supply side performance of the U.S. has also been helped by strong labor force growth. We've been running much faster on immigration flows, and we've been getting the labor force participation rate of prime age workers up. So, some of the optimism, I think, on the U.S. comes from the fact that while we've had strong demand in the last year, we've also had very impressive supply, both on productivity and labor force.
How do you and your team respond to people that say the 3 stimuluses will drift away, we'll have the end of the Biden stimulus, if you will, and then we'll slow down again to lethargy? How do you respond to that insight?
Well, I think we are going to slow down. We grew almost 3% over the last 4 quarters, and I think it's right to say fiscal policy supports were helpful in that. And, that's not going to be there for the next few quarters. I also don't think the Fed is about to ease, so that's not going to help us. But I think what's been missed here most in 2023 is the fact that while the Fed's been tightening a lot, the underlying health of the private sector, both households and businesses, remain quite strong. So I think we will slow. But I don't think this is an economy that's at any imminent threat of anything really bad happening.
Bruce, it's been incredible to see unemployment still south of 4%, GDP close to 5%, and to get inflation converging towards 3%. I think that's the question we've got to sit on, though, just for a longer amount of time, Bruce. What are we converging towards? Are we consolidating around 3% inflation, or are we going back towards 2%?
Well, that's our view, is that we've made some good progress. We've gotten a lot of the damage done around the pandemic out of the pricing space, but that there still is a stickiness here. As you say, labor markets are tight. I think we've also shifted psychology somewhat, and you can see that in some of the inflation expectation measures. Yesterday's report was clearly a positive, and I would note it was also positive for growth. Keep in mind what's happening in the energy space. We had a flat headline reading, but the core numbers are still running on the last 3 months around 3.5%. I don't think that's going to change in the next few months. I think the Fed is going to be patient here, but I don't think this is a victory, and I don't think we're going to be giving the Fed room to ease off the inflation numbers anytime soon.
That's what they want us to believe, and that's what everyone's going to say, and that probably will be right, Bruce. Maybe. We don't know. Does it even matter, though? Are we looking at the next 2 months, no data that's going to come out that's going to really alter this sort of Goldilocks, amazing nirvana view that seems to be imbuing markets with this glow? Is there anything that could possibly shake that, just in terms of year-over-year comps, over the next 2 months heading into year-end?
Well, I think on the economy side from corporates, we had a very strong third quarter in GDP. We're seeing that in profits. What we're going to see today, we think, is still underlying gains in retail spending. I don't think the economy is going to weaken that much. As noted, the supply side is okay. So I think the profit picture looks good. I think the economy is slowing, but not looking bad. I think there's an equivalence here, though, between an economy that can get onto a sustained path and get inflation all the way down, and one in which the Fed is going to have to stay high for long and is going to gradually erode health through restrictive policy stance. That's our baseline view, but it's going to be a gradual story, and it's going to be taking some time before we can distinguish that from the more optimistic one, where we get all the way back and have a sustainable economic expansion where the Fed can take its feet off the brakes.
So are you pushing back against market expectations yesterday for 50 basis points of rate cuts by next July?
Yeah, for sure. I think if we had a much worse economic environment, something that scared the Fed on growth, I think you can get some Fed easing. But I don't think the inflation news is enough here in terms of what we're seeing to get the Fed to think about taking anything back, at least not in the next few months. Where we're going to be in the middle of next year, I think if we got surprised by supply side and inflation, there's some opportunity to move. But that's not our baseline view.
Hey, Bruce, thank you. Bruce Kasman there of JP Morgan on the latest. I heard this a lot in the last 24 hours. You look at the market's declaring victory in the fight against inflation. You ask people what they think the Fed's going to do. They're not going to declare victory anytime soon. And I think you heard that from Bruce just then for a whole bunch of reasons. I want to turn back to Target. In the pre-market, it is positive. Leaner inventories, the numbers are better. The stock is flying, up by more than 11% right now, up by 11.7%. Comp sales, not as bad as expected. Third quarter sales, better than expected. Bramo. Earnings look way better. Big upside surprise, 210 versus an estimate of 147.
This really stems from Target's issue trying to work down a bunch of inventory. They had a real inventory bloat, especially relative to Walmart. They seem to have been working it through, down 14%, even though at least food sales, among others, were actually down year over year because inflation was coming down. The prices were coming down. So it leads to this sort of push-pull of just specific store management rather than a larger kind of call.
NVIDIA, John, you're talking about LVMH and the rest. We go back to 2019. Let's do that on Target. And I think we forget the pandemic impact here that was just absolutely ginormous. 20-year chart on Target on radio. It's a nice typical Target trend. And John, in the autumn of 2019, boom. And all we've done is go round trip off of where we are today with a nice bounce today.
So I ran the numbers on NVIDIA yesterday. So we're talking about Target, a $51 billion name, by the way. NVIDIA, 10 days of gains, up more than 20% over that period. $200 billion plus of market cap added to that name, Bram. I mean, like, that's ridiculous, Bram.
Target's a rounding error for the gains on NVIDIA.
That's the best way of putting it. From New York City this morning, good morning.
I think they're doing the right thing to pause for now. You know, they've raised rates a lot, you know, to wait to see the effect on the economy in the U.S., particularly as the fiscal spending The excess fiscal spending is winding down and quantitative tightening is kicking in. But I still think you should prepare. They might have to do a little bit more. And I think people should be prepared for that just as a kind of a risk management tool. And I'm afraid inflation may not go away that quickly.
That was JP Morgan CEO Jamie Dimon speaking in an exclusive interview with our affiliate, El Financiero Bloomberg, over in Mexico, doing some great work. I think the key line there, a risk management tool. TK, this is a business leader who runs a bank who has to think about the risk that maybe rates stay at here for a longer period of time than people anticipate because inflation is a lot stickier than some people think.
I think the capture of profits, these guys are working overtime playing macroeconomics because they don't want to admit what they're doing. They are the second bank of the United States. Take the combined profits of the four larger banks, and it's not much different than what Andrew Jackson was worried about.
I think
they don't want to talk about that.
But it is instructive to hear kind of where they see the balance of risks, not as a Federal Reserve, but as a massive bank, the biggest bank in the United States.
And what they're gleaning from their information.
Right, but is the balance of risks shifting now to people getting overly complacent that the Fed is done? And that sort of raises this question, where is the pain point? You were asking that earlier. Is it a better than expected economic trajectory next year, or is it a worse than expected economic trajectory? That I think is an important thing to discern.
We have touched on something I think we've got to really work on over the next couple of weeks. What is the bet now? Is the bet that inflation is no longer a threat? Is the bet that the Fed is done? Yeah, I mean, clearly based on the last 24 hours. Does it go beyond that, though? Is the bet now that rates are going back to where they were before? At 3, 2, maybe even 1% in the view of UBS. What is the bet right now?
The bet, as I can see it in Fed funds futures, is for rate cuts to accelerate into year end, but for rates to stay higher, 4%, 3.5%, not necessarily going back to pre-pandemic levels, and that the economy can withstand it. That, to me, is really the key question. The economy can withstand it, and capital markets will continue to chug along. That, I think, is actually a big question mark in terms of what the real neutral rate is. So, that's sort of the nuanced way that the market is calibrating.
You want to go to me on this?
Yeah, of course.
I say total baloney. It's a parlor game of Fed futures. What matters is the job economy, and what we're going to see, as Bruce Kasman just talked about, productivity. We have misguessed the productivity recovery in this nation.
Yeah.
And this Hotzius-Zentner divide on the unemployment rate is factors more important than gaming out the dots.
I love it when you're both on the same page without even realizing it.
It's great.
Beautiful thing.
I say something.
Marriage.
You're wrong,
total
and then repeats
baloney.
it.
It's about the nuances in terms of where rates end up.
I don't want to talk to Jen Bartashis. Bramwell and I are going at it. Let us get briefed here to save the marriage. Jennifer Bartashis, the marriage counselor, joins us with Bloomberg Intelligence. Jen, thank you so much for joining. I want you to explain what falls to the bottom line. Home Depot has a net income margin of 9-ish, 10-ish cents. Target, I was shocked, is 3 or a moldy 4 cents on the dollar. Is anybody making money in this business?
Good morning, Tom. It's a good question, and it's definitely one of the challenges that we always see in this retail sector. But I have to say, Target's results today were very encouraging. And it does give a little bit of optimism for the fourth quarter. So when they beat across the board with revenue, same-store sales, we did see a great increase in margin. That's all really because some of the productivity initiatives that they've put in place are starting to really help take cost out of the business.
Walmart bounced on this news as well. It's up in the pre-market by more than 1.2%. Jen, we'll hear from that company tomorrow. What is the read across from that company to the other?
Well, I think that Target having better than expected results, it really only means good things for Walmart. Walmart does tend to outperform in environments where people are pulling back or being very careful with their spending. And so I think that a better than expected result today may lead to a very good outlook for tomorrow as well.
But Jen, how do you parse through just the management side of things versus the macro call? On a management side of things, Target seemed to work down 14% of some of its excess inventory, leading to some of this boost. Does that really cross over to some sort of read through in the broader consumer?
Well, I think that what we've seen is across a lot of retailers, they've had to figure out their inventory in kind of this post-pandemic world. We went through a phase where everybody was stockpiling inventory so that they had stuff available. Then they had too much and they had to clear it out. And now they're trying to find the right equilibrium. And being down versus last year where there were still concerns about supply chain constraints just shows that we're really getting back to that equilibrium. And we're seeing it across multiple retailers. And so I think what's important is that inventory is down that much, but they are already stocked for holiday. So to us, that also means that they should be able to sell through a good portion of their inventory over the holiday season and not end up in the same position they were in, where they had to have a lot of markdowns post-holiday.
Jen, yesterday we were talking about drugstores in certain cities that are putting pictures of toilet paper behind the shelves and then having people request for it to be delivered to them from the back of the store. Target did talk about theft, or shrink as they call it, and saying it's still weighing on their margins in a material way. What do you make of this? How long are we going to hear about this in earnings? And is this just simply an excuse for margin pressure, or is this something that is going to become increasingly concerning for both investors as well as the corporate executives?
Actually, what we usually see in longer term cycles is that theft escalates whenever the consumer is under pressure. And as inflation is coming down, that actually should be a little bit of a release on that pressure with regards to theft and the losses that retailers are having. People generally want to do the right thing, and Target in particular has been very vocal about theft levels. We saw some store closures where they said it was just not profitable to operate. But we do think that as inflation comes down, that should get a little bit easier going forward.
Jen, you don't do buy, hold, sell, but I want you to note a 4% dividend, an 11% 5-year dividend growth. I got a multiple of 15, which is what, 1/3 of the high flyers, 1/5 of NVIDIA in that. Can Brian Cornell and his team say we're back on plan, the pandemic's beyond us, and we will have the glide path of the Target we knew years ago?
I think we might be at a turning point. It might be a little early to say that we're already there, but I think that today's results definitely indicate that a lot of the strategies that they're retrenching, that they're putting back into place, do put Target back on that right trajectory.
Jennifer, thanks for the update. Let's catch up again tomorrow when we get numbers from Walmart. Jennifer Bartash is there of Bloomberg Intelligence. Target in the pre-market absolutely flying. Bramo, I'm pleased you brought up shrink. In other words, theft. Because Target today basically saying it offset margin improvement in particular areas of the business. I'd love some more clarity from the company on the call maybe a little bit later this morning, Lisa. I think we'd all love some detail around that because margins were better than expected.
I would love to hear details, numbers. They didn't offer any of them. It would be interesting to see if they can give some sense of how much more they were seeing margin compression because of theft and what they're doing about it, right? I mean, we talked about store closures in September. There was a lot of pushback saying, well, these stores just didn't have the same kind of foot traffic. Again, how much is this being angled in the media versus something that's very real that we all feel when we walk into a store and it's affecting our consumer experience when everything is locked behind,
Well, that's why the foot traffic's down, right?
Well, I mean
clearly.
Exactly. How do you compete with Amazon or any other pick your online shopping site if you have to go in, press a button, wait for someone?
I think it's, you mentioned the dreaded A word they don't want to talk about, which is Amazon. And Amazon's going to close their mouth on this. To me, I'm so biased by what I observe here in New York City in a lofty 3 zip codes above 59th Street. I can't imagine what I observe is across the nation as well. And on that conference call with Target today, that's really the key question to your insight. I mean, is shrink from sea to shining sea? That's the arch question.
The statement that came out in September from Target, there were 9 stores across 4 states, Tom. We had 1 in a Manhattan location, 2 in Seattle, 3 in Northern California, 3 in Portland, Oregon. This was a statement from Target. We cannot continue operating these stores because theft and organized retail crime are threatening the safety of our team and guests and contributing to unsustainable business performance. What would be upsetting for the likes of Target, CVS, pick a company, whoever it might be, is to see how quickly you can address some of these issues in places like San Francisco when someone important comes to town.
Well, the quickly is the part of it.
Can they maintain that? Can they maintain that?
Yes, but my question is, why can't we just fix this now? I mean, in the old days, it was simple. If I went into Chilson's Drugs and stole my 14th Mars bar, I was in the timeout chair for what, 6 months, 7 months?
I have to be completely honest. I actually observed it myself, somebody clearing shelves, and there was a cop on the corner, and I went up to them and I asked them about this, and I said, there's somebody in there literally clearing the shelves. Are you going to go in and arrest them? And he said, no, because what's it going to do? We're going to collar them, and they're going to get released in 24 hours, and essentially, this is going to waste 8 hours of our day that we could be doing other things. These are some of the challenges, just to give you a picture.
I'm with you.
Of the view.
You speak to the police officers, the morale is just kind of rock bottom on this issue. Just really, really difficult, TK. Not getting support from where they need it.
I call it a solvable problem.
Coming up, Sam Stovall of CFRA on this equity market. It's up again this morning. Good morning.
Our view is that the Fed probably is done.
For the Fed, yes, the bar is high for another hike.
We will get a period of slower growth, but that's not surprising.
There's disinflation in the U.S. economy, and we're heading back to 2%.
The question is, how long does it take to get back to that 2% inflation threshold? And I think in that context, we have to have patience.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
It's the land of milk, honey, unicorn and rainbows. It's the everything rally in this equity market and in this bond market too. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Your equity market positive again this morning on the S&P, up by 0.4%. TK after a monster day of gains in yesterday's session.
A monster day yesterday, John, and you see it in the VIX 14.24. It'll be interesting to see how that adjusts here. But what's important is the market's lifted in the last hour. There is a continued bid to this market exactly like there was yesterday. I waited for some sense of pullback yesterday. It just never came.
Just didn't get it. Best day of gains on the S&P since April. Lisa, we went through some of the numbers earlier this morning. We'll do it again. The small caps up by more than 5%. Best day this year. Real estate gets some relief off an aggressive move in the bond market. Yields down. Real estate on the S&P. Best day in 2023.
The sound of victory being cheered across Wall Street, the victory of having won against inflation, maybe, maybe not, we shall see, but it doesn't matter. I think that's ultimately the question, and we kind of heard that tone from Ben Gutteridge, where he was saying, enjoy the spoils of market momentum. How many people are feeling the same? Ride this puppy, as you would say, Tom, to the end of the year, because it doesn't seem to be showing any signs of abating.
There's seasonality here. Ben Laidler out with a smart note today, 1/5 of the money's made in December. You know, a lot of good research on that. But, John, as we were going to air here, folks, Mr. Ferro mentioned those people that have enthusiasm, but they're really sort of kind of like not fully invested. What do you do this morning?
If you
Those
missed
are the
yesterday,
meetings.
TK, if you missed yesterday, this morning it's hard to get into. You look at moves like that, and you weren't involved. You hear from smart people like David Costin over at Goldman Sachs talking about limited upside on the S&P 500, Tom, even with a constructive view on the economy for the next 12 months. It's hard. You get stuck. You get stuck. People are talking about this big move out of cash. Cash is still paying 5%. It's difficult, Tom, when you miss these moves.
Our team continues strong. Great equity coverage yesterday. Nadia Lovell, I thought, was particularly strong from UBS. Sam Stovall with us, truly the legend with us here in a moment, John, to give us perspective on what do you do when you see this kind of bid. Was it a short cover? Was it a fake, as Lisa alludes to, or is this the real deal? And I'm going to go back to 1977 when nobody believed we would get to 1982.
I think it was a sprinkle of absolutely everything in the last 24 hours from all corners. Need to talk about Target just briefly. That stock is higher in the pre-market by almost 15%. You're going to hear from Walmart tomorrow. You'll hear from Macy's as well tomorrow. You hear from the Gap as well. The starting gun has gone for the retailers, Bramo, and it's good news so far for Target, up big time.
Up big time as they work down some of their inventories. The key question is, does this indicate people trading down or shifting back to basic necessities, or does this really indicate an all-out buying spree that indicates that strength that people are talking about, even with disinflation? We just don't know.
We don't know, but it's better news, isn't it?
It is better news.
Year-end.
It's so much better news, which is the reason why...
Happy Bramo.
This is happy Bramo. I'm buying things too. I'm buying a refrigerator.
Does such a thing exist?
Lisa keeps telling us that she's spending money on a refrigerator.
I'm so excited.
Buying an automobile as well.
Yeah,
look, busy weekend,
it's going to be exciting.
The Dolce Gabbana Smeg, the one for $55,000.
When Lisa starts spending down the savings, is that a contraindicator? What does that mean?
Yes, it is.
That is John Taylor at Stanford. That's way beyond me.
Everything else is broken.
If Lisa's capitulating and starts to spend...
It is. It's
because...
What does that mean for the economy next year?
If freezers break, then other people will be buying refrigerators too.
Okay.
8:30 a.m. we get U.S. retail sales, which will offer a different view than just simply a refrigerator, as well as PPI data. But do we see the same kind of enthusiasm in retail sales as we saw last month? To me, this is really key. Is it good news to see a huge bump up in retail sales, especially with disinflation, that will dampen the overall nominal levels? We also just did have results from Target at 7:30 at about 25 minutes. We do get TJ Maxx. I think TJ Maxx is going to be really interesting because usually it does better when people are looking for discounts. And so, do you look at strength in this name as a positive or as, something of a cautionary signal for the economy?
So what does luxury do? John, you've been on top of this. I mean, what does LVMH
You're on top of it a little bit more than I am. What
does Louis Vuitton do and all that into the holiday season?
If you look at the stock price, we've wiped out the gains for the year in a lot of those places, Tom, including LVMH.
Yeah.
And a lot of that has to do with China and whether the Chinese buyers are going to come in, which brings us to the next thing that we're watching.
Thank
you. APEC summit taking place, headlined by China's Xi Jinping and Joe Biden. They're going to meet later this afternoon in New York time, 11 a.m., I believe, local time in San Francisco. You can expect all of the photography.
More handshakes like this one.
Yes, exactly. You can expect that. At 10:30 p.m.
It's a handshake. Great
Xi Jinping,
it's a photo op.
It's beautiful.
Is it one of those soft ones? I hate those soft ones.
Oh, no, the fist bump. We can do the fist bump.
No, but the soft bumps where it's like this.
Wonderful to see you.
But what if people have a problem with their hand?
Do you know what I see him do, Bramo, that I hate? TK does that left hand thing. Where he sticks out sort of like a wet left hand.
That's because
a wet left hand.
That's because I'm over here and I'm shaking. John, wait till the first arthritis clicks in.
Wet left hand.
This wet left hand just sort of reaches out, and I have to apologise for him everywhere we go.
Really?
I'm sorry about him. I'm so sorry about him. It's like kiss the ring.
Anyway, 10:30 is the meeting that Xi Jinping has with this.
We moved past that, didn't we? I'm sorry. Sam Stovall's with us now, Chief Investment Strategist at CFRA. Sam, important question. I'm asking for a friend sitting next to me. What is your advice this morning to people who missed out on that rally just yesterday?
Well, advice, or more like just commentary, is my favorite financial philosopher, Charlie Brown, once said, I have a feeling that when my ship comes in, I'll be at the airport. So really just don't try to be at the airport or the shipping lines when you should be at the airport. A 9.3% compound annual total return going back over the last 35 years becomes 6.6% if you miss out on the 10 best days. Also, the fourth quarter pre-election year for first-term administrations has been positive 100% of the time with a total return of about 6%. We've already exceeded that. So essentially, there's still likely some upside potential in the second half of this fourth quarter, but much of the gains have already been made.
Sam, the night after the crash of '87, the Friday on Wall Street Week, Robert Kirby came from Capital Guardian Trust and American Funds in L.A. to New York to speak with John Templeton, Peter Lynch, and others about the end of the world as we know it. The Investment Company of America has delivered 11.84% per year since 1934. Tell our listeners how they can buy and hold constructively.
Well, I think, first off, just understanding stock market history can serve as virtual Valium. It can calm your nerves because you realize that while having declines is a very normal aspect of Wall Street activity, that the pullbacks, 5 to 10% declines, have recovered everything that they lost in an average of only a month and a half. Corrections, declines of 10 to 20% have taken only 4 months on average to get back to break even. So you're really better off buying than you are bailing. And also remember what Louis Rukeyser said on that Friday evening was that, your dog still loves you, your family still loves you. The market will do what it does.
I can't take this seriously. It's fantastic. Your dog will still love you. Your family will love you. Virtual Valium, better off buying than failing. Sam, a lot of these beliefs, though, grew up at a time of an incredible bond rally that was driven by this idea of very low interest, very low inflation, and that really underpinned a lot of the equity returns. I understand over a long term, stocks have performed well. If rates don't go that much down further, how much does that affect the benchmark expectations for returns in stocks?
Well, you're absolutely correct that, in a sense, we've gone through two secular changes since World War II, where we've had a rise in interest rates from post-World War II till the middle of 1981, and then we've had a secular downtrend in long bond yields. So, yeah, you probably do have to split them up, and the double-digit gains that we saw in the secular downward move in interest rates are not likely to be repeated because they were significantly smaller when interest rates were rising. However, we're pretty close to what the long-term average rate is. The St. Louis Fed gives away free data, and the average since April of 1953 is 5.25%. So that's pretty close to where we peaked out in earlier October. So I would tend to say it's really more a question of corporate profit growth, valuations, et cetera.
Sam, can we talk about biggest risks now going into 2024? I'll give you one or two options. Do you think the biggest risk right now is that we get a material slowdown in the economy, or this kind of strength that we've seen so far in 2023 persists into 24? Which one is it?
Well, I think the biggest concern right now is probably the strength, because we've been calling for a recession for the last 2 years. And does the boy who cried wolf still get credit for the wolf finally arriving? So I think the real question is, we can look for retail sales today. The street is expecting a 2% decline. We think we might, or a 0.2% decline. We think we could see a 0.2% rise. So the consumer is still remaining fairly resilient. But if they continue to spend and add to their debt levels, that could slow things down. But right now, I think the worry is that the Fed will not be raising or cutting rates by May of next year, but rather probably by the third quarter or maybe even later.
Just quickly, Sam, TK wants to know, is good news today, or is good news bad news?
Well, for the next week, I think good news might be bad news, because the market typically declined in the 7 days after a small cap rise of 5% or more. However, we do tend to right ourselves 30 and 60 days after, up close to 6% for small caps.
What a game. Sam Stoffel of CFRA. Thank you, sir. Retail sales about 80 minutes away. We'll see if good news is good news, or for that matter, if it's bad news, Bramo, a little bit later this morning.
Honestly, the key question is, what if it's not that great? We get good retail sales, but they're just like, you know, they're fine.
Lisa's back.
They're That's actually the best news that we could possibly get, right? Like mediocre news is the good news. That's my take.
That would cheer you up.
I think that would cheer a lot of people up, because it wouldn't necessarily be inflationary, but it wouldn't be the retailers falling off a cliff. Okay. It would be, you know, a soft landing nirvana.
Like when you buy a Christmas tree, are you going for the fine, that's okay Christmas tree, or do you really want to support whole paycheck and, you know, get the 3-digit one?
I want the sad tree that no one else will get, but I will get and make it beautiful.
You're that person that chooses the runt of the litter, aren't you, when you go to buy a dog?
Yeah.
Okay.
There's no run of the litter with fake trees, is there?
You don't.
They're all
you
perfect.
You pick
They're all perfect.
I pick winners, Bramo. That's what we do. If you're just joining us, welcome to the program. Stick around. Equity futures on the S&P positive here by 0.5%. Yields a little bit higher by a couple of basis points. 446.28, Tom. What a 24 hours in this market.
24 hours, and this is really the message this morning, even with the bond market with yields up 2 basis points after the festivities yesterday. John, I got a flat dollar. I have a bid on equities here. It's really important for people waking up here, radio and television, that 6 a.m., 7 a.m., what are we going to see at 8 a.m. in retail sales? There's a bid coming in. And I'm sorry, some of it is Target.
Well, there wasn't necessarily anything negative to cast any pall on what has acted as virtual Valium as people look out into the gains. What Sam said there, though, about the balance of risks, to answer your question, I thought was really interesting. The balance of risks, still strength. The more people keep worrying about recession, the more it prolongs it. It seems like that's sort of the case. And it's the moment that people start saying, you know, recession is off the table and, you know, lean into risk, do we start to see that shift?
Yeah, he said the boy who cried wolf, and I think all year we've said the economist who cried recession. It's kind of been the story of 2023. Equities are higher by 0.5%. TK mentioned Target. That stock is up by 15.3% in the pre-market. Henrietta Trays of Vader Partners is going to join us in DC up next. It's Fight Club Mark II in Washington. Tom, more still to come. This is Bloomberg.
When it comes to government funding, as I have long said, it has to be bipartisan. And right now, that's the path we seem to be on.
We are not going to have a massive omnibus spending bill right before Christmas. That is a gift to the American people because that is no way to legislate. We've gotten together. I believe there's going to be bipartisan agreement on that to break it up.
Some very good news in Washington, D.C. That was Senate Majority Leader Chuck Schumer, House Speaker Mike Johnson speaking just hours before a bipartisan vote in the House passing a stopgap funding bill that would avoid a potential government shutdown. That bill now moves to the Senate, and TK, we can move on, at least for about a month.
Well, that's what they say, but it's a month into January, right? I mean, to cut to the chase, we're doing this again after the first of the year.
Yeah, once and then twice. It's going to be fun.
Twice even. I don't know. I don't think it's healthy. I don't think it's good. I'm going to go to Robert Hormats in his great book on you got to have a sound fiscal house to prosecute domestic and foreign policy. I would suggest right now, particularly with the violence we saw yesterday, that or threatened violence.
Well, the threats of violence is
threats of violence.
A more accurate way of putting it. Yeah.
It's maybe too much. I mean, Hugh Morris in the Telegraph, this from a number of years ago, the 7 secrets of the Houses of Parliament, which you won't learn on its new virtual tour. We're thrilled. I mean, John, this is important here as we go to Henrietta. This is a tweet. Ian, thank you so much for efforting this bit of Ferro history to us. And it's real simple. I mean, there it is. Violence in the United Kingdom Parliament. There are lines in front of each bench in the House of Commons still. MPs, what's MPs?
Members of Parliament.
Members of Parliament, thank you. Must stay behind them, toe the line, and let's stay at least a sword length away from the opposite MPs. And they're serious.
I didn't know that, Tom. I don't know if you fact-checked that, but I did a little research myself in a commercial break. I'm told the Sergeant of Arms
has a sword,
is the only one allowed a sword.
Yeah, it's like the one in the beginning of Game of Thrones.
Ceremonial stuff, just like that.
Just like
very
that
accurate
one.
Game of Thrones.
But it's a sad state. I mean, to be honest with the video we showed in the last hour, for those of you on radio, the video is more shocking than the language. I mean, to me, it is a new threat, a new violence.
Is that what you think?
Yeah,
I think we're going to see more of this kind of thing down in Washington.
Yeah, well, there's always stupid stuff going on in Washington, but this is a new...
This reminds me of just, high school TikTok videos that people send around to try to look cool.
Yeah, but it's Congress.
Exactly.
Exactly. Expert on this, and she's good with a sword. Henrietta Trays joins us now. Economic Policy Research Director at Veda Partners. Henrietta, with all your years of experience in Washington, how polarized is the polarity right now?
I mean, they are just at each other's throats, almost literally. Certainly, the stories out of D.C. yesterday were just shocking. Frankly, they have to go on recess. I am so thankful that they have agreed to this kick the can approach. As you mentioned before, I think we're just going to be doing this again. And I'm not optimistic that it's going to stop in January or in February when the 2 current deadlines exist. We're going to be doing this every couple of months for the rest of 2024. So we should get used to this kind of acrimony, government shutdown risks. Those headlines should just be permanently emblazoned every couple of months in the newsreel.
We've got those headlines ready to go, Henrietta, through the whole of 2024. Can you just frame how big this fight over spending might be just next year?
It's just loud. It's not a big fight. It's just a loud fight. They are not getting any reductions in federal spending. This is a clean CR. There will be a minimum of about $100 billion in additional aid that goes out across domestic and international priorities. We are not fighting about spending cuts. We are fighting about the process. The Freedom Caucus came up with the idea of doing this laddered approach. It was rejected, resuscitated, and then finally included in part in this deal, but it contains no spending cuts. And there's no scenario where the second tranche, which includes defense and foreign operations spending, is going to expire after they reach a deal on the first couple of appropriations bills. So this is a lot of sound, this is a lot of bark, very little bite.
Given the fact that there was not Israel or Ukraine funding in this current bill, how likely do you think that will get done by January, by February? Does it even matter considering the spending that's coming out of different pockets?
That's a really important question, and I think a lot of this is tied up with Minority Leader McConnell and how much clout he continues to have with the party. I think we can't underestimate the impact of the loss in Kentucky for the governor's race. That materially impacted his standing with his own conference in the Senate Republican caucus. And I think that's a big problem for Ukraine aid. I was surprised in my last round of meetings in D.C. how little support there is for Ukraine versus what there has been from the United States for the last year and 8 months, it is really a iffy question on whether Ukraine aid gets provided at all. I do think that keeping Israel aid off of the CR that they're passing now creates at least a pathway. But when you tie Ukraine to the border and recognize that we haven't had border security legislation pass in a decade or more, you really have a problem. So I think that it is good news that we don't have a bill yet. It keeps hope alive. But I would dim my expectations for robust aid to Ukraine. And Israel, obviously, is another problem that is splitting the Democratic Party just in half, just ripping it apart. So those packages are going to be really hard to come by, and I wouldn't be surprised if they didn't get it till January.
You know, it's getting harder and harder to parse through the signal from the noise in Washington, D.C. We have all these real, tangible, important issues, and yet we are focusing on scuffles, both in the Senate that Bernie Sanders had to end with a wooden gavel, and then the accusation that Kevin McCarthy elbowed fellow Republican Congressmember Tim Burchett during some of the contentious negotiations. Are any of these important to you on a policy or just functional level?
There is no policy. So I think when you, Tom, you actually just made a statement about how if you don't have your fiscal house in order, you can't enact policy. That's exactly what's happening. There is no policy, so we're only talking about fiscal austerity. There's no discussion about passing a year-end tax bill that's of any kind of merit. They're running around punching each other in the back because they have gripes and qualms with who's a liar, who has trustworthiness. There is no policy. There's no uniting policy that drives the House Republican Conference, which is in control. And that means that the Senate can't get their act together or get their work done. And it's really been a dearth of leadership that I think is exacerbated by Mitch McConnell being on the way out and a speaker that is untested with no real leadership mandate to work with on the Republican side. So I think there is no policy. I don't think we will be voting on any meaningful legislation next year. They cannot move forward on impeachment. They can't move forward on, impeaching even the Homeland Security Secretary. They don't have a plan for the border that is comprehensive or can pass with the Republican conference. When you have these tight majorities and a lack of leadership, this is where you land. So we just have these short-term fights about federal spending. Thankfully, we don't have to deal with the debt ceiling next year. That would have been a real problem.
Well, Henrietta, given everything you've just said, doesn't that make it all the more amazing that we managed to find an agreement in the House yesterday?
I mean, yes, and I don't want to be just contrarian, but the scenario where we shut down is even worse because there's no path to reopen. So if you shut down the government, we will be shut down for quite some time. People talk about, we couldn't possibly go past 2 weeks because you'd miss a pay cycle. The last time we did this for no good reason with no end in sight, we shut down for 35 days right over the Christmas holidays. I think the one thing that's kept my optimism alive, contrary to a lot of popular opinion, with 20% or less odds that we'd shut down all year, is basically that the alternative is worse. Shutting down means we stay shut down for quite some time. Everybody looks incompetent. And you can't have these fights about fiscal austerity and spending if you're shut down. It starts to have a material negative impact. So, they're both bad options, but shutting down is the worst one.
Well, lots of them look incompetent when it's open. Henrietta Trays there of Vader Partners. Henrietta, thank you. TK, Dan Tannenbaum writes in, sanctions expert. I hear they're bringing the jewel back to settle disputes in 2024. The last 24 hours has been nuts.
Jim Shanos' national, the museum over in Central Park West, the historic New York Historical Museum, has sculptures of Burr and Hamilton, like life-size, like how far apart they were. The pistols are huge, and it's frightening. I mean, I was scared stiff when I saw it. Made me jump.
Pistols.
Yeah, made me
Instead,
jump.
they're running around punching each other in the back, as Henrietta Trays was saying. But at a certain point, how do you move forward if basically what she's saying is this masks the fact they've got no policy? It creates a real issue.
Yeah. As an aside, with China coming to San Francisco, there is a sea change overnight. Our Erica Yokoyama in Tokyo, John, reports a brilliant story on the collapse of the Japanese economic experiment. Nominal GDP on the Japan malaise, under 1%. Shock inflation reports, shock real GDP there. Torsten Slot cuts to it simple. 10% of Japan's over 80 years old.
That's quite a stat, isn't it?
That's a stunning stat.
Coming up next, we'll talk about the bond market. Subhadra Japa of SocGen, that conversation just around the corner. Equities positive here by 0.4% on the S&P from New York City. This is Bloomberg. The rally continues on the S&P 500. Here's the shape of things right now. Stocks are up on the S&P, on the Nasdaq, the Russell. On the Russell, the small caps up in a monster way in the last 24 hours, up by 0.6% on Russell 2000 futures. Yesterday, small caps up by 5.4%. Best day of gains in about 12 months on a Russell. On the S&P 500, best day of gains since April. Within the S&P 500, every sector in the green, real estate, top of the pile. Best day this year, helped out by the bond market. Check it out. 2-year, 10-year, 30-year. 10-year right now, sub 450, 447. Yields are higher this morning, but aggressively lower in yesterday's session. 2-year out to 30-year. The yield, Lisa, dropping by double digits in the last 24 hours.
So I think that what we need to do over the next couple of months is parse through the distinction of, okay, the Fed may be done, but how much are they actually going to drop rates? And we've been talking about that all morning. There's a big distinction between kumbaya, hallelujah, wow, we're going back to low rates, versus we're going to stay here and see what happens, especially given the long and variable lags.
I go back to the physics of it, maybe the Newtonian calculus. To me, it's a vector play. It's not about getting to a given point, or, as Jim Bianco would say, leveling out here, which is a real tangible probability and outcome as well. It's just the vector confidence went through the moon today.
This is what we've been talking about, Tom. Yeah. What's the bet right now? Is the bet that the fight against inflation is over, one? Or is it two? It's over and it means the Federal Reserve can aggressively start cutting interest rates. They're two very different stories going into next year.
Well, we need more data. And I'm sorry, we haven't made enough of a deal about it, folks, because I'm in shock over the equity markets yesterday. In 29 minutes, John, retail sales. And I'm sorry, it was important yesterday. It's ever more important now after the celebration that we saw yesterday.
That data point about an hour away. We've had a sneak peek of some of the numbers from some of the retailers in America. Target this morning, up in a major way in the pre-market. It's higher by more than 15%. We just heard from TJX. Lisa, the numbers from them at first look pretty decent as well. $1.03 on EPS. Looking at some of the numbers elsewhere, raising full-year guidance for comp store sales and earnings too.
Yeah, talking about full-year earnings per share of $3.71 to $3.74 versus the expectation of up to $3.72, just coming off a touch because it didn't beat necessarily all that much. But to me, it really highlights how companies are still seeing inline operations, even despite all of the optimism baked in. Again, I want to hear the commentary. The commentary might be more interesting for some of these companies based on what they're seeing going forward and which consumers are coming to them. Is it people looking for bargains?
There's always been this huge respect for TJX. And to go to the net income margin that I mentioned earlier, Home Depot, 9 cents maybe on the dollars, what they take down to the bottom line. Target, really a different paltry view of 3, even 4 cents on the dollar. TJX is very Home Depot-like. I mean, the profitability, 8 cents on the dollar is pretty darn good.
Numbers at first look decent. In the pre-market, the stock is totally unchanged. More on that name a little bit later. Under surveillance this morning, Israeli troops entering Gaza's Shifa hospital compound. As military operations intensify, Israel saying the move is part of a, quote, precise and targeted operation against Hamas. Israel also adding it's bringing supplies into the facility, Lisa, which houses hundreds of patients, medical personnel and displaced civilians. US intelligence confirming Israel's view that Hamas uses the hospital to conceal and support its operations. This is a big focus in the last day or so.
It's a massive focus because the idea of a hospital at the center of a war is absolutely offensive to everybody. Who to blame? You can go and play the blame game all around the table. There is a key question, though. How much more time does the Israeli army have before they cannot continue with the support that they have from Western leaders? You hear President Biden getting louder in his frustration about the civilian deaths. There feels like in 2 to 3 weeks, there will be some sort of conclusion in some sort of capacity.
So who's going to police them? Which outside force is going to tell IDF what to do? I mean, that's what I don't get. I get the diplomacy, and I get the goodwill of it and all that. But this is absolutely original because of the immediacy of media, the immediacy here of this hospital with tangible images. There has never been a war like this before.
This military conflict, I have no doubt, is going to be part of the conversation with Xi and Biden a little bit later. Not just this one, but also the one in Ukraine. That meeting, one to watch a little bit later on this afternoon. Elsewhere, the tentative agreement between GM and the UAW at risk of failure as 2 big plants voted the deal down. 16,000 workers have voted so far, with just 52% of them approving the contract, according to the UAW. Lisa, the close margin setting up key ballots at plants in Fort Wayne, Indiana, and Arlington, Texas. The voting deadline, 4 p.m. Thursday. Union workers for Stellantis and Ford have shown more support so far.
GM seems like it's had a perpetual issue with the UAW and much more sort of intractable conflict in terms of getting to some agreement. Not really in the headlines, the buyouts that Stellantis and Ford and even GM have been doing, which to me is interesting. They're trying to cut costs where they can. They're going after non-union workers who've been there for 5 years or more. But to me, what this highlights is how much is this a last gasp before some serious changes come to some of the plants that are struggling in the face of new competition and new products.
Shift to EV. It's going to be so difficult. I think we're all witnessing that in the last few months. Final story for you. Citadel founder Ken Griffin saying he'll decide soon about financially backing GOP presidential candidate Nikki Haley. Griffin caught up with Bloomberg's Sonali Basak in Miami.
Are you supporting her financially yet?
That's a decision that we're actively contemplating. I mean, we're at the finish line on that choice, yes or no. But I think the real issue is Donald Trump, for all of his bluster, willing to get on stage with Nikki Haley or not?
Ken Griffin has Citadel. TK, quite a day for Nikki Haley in terms of some of the big names in finance. Jamie Dimon, according to Axios, has been privately talking with Haley about the economy, suggested to be impressed by what she had to say. And now you've got Ken Griffin with a lot of financial backing, Tom, to distribute going into that campaign next year.
The confusion here is the former president is associated with his tower on Fifth Avenue, right next to the Gucci kids store. And he's supposed to be a New York City guy. And the reality is his fortress is in Florida, and that's where his foundation is. And these guys are searching for somebody that can represent business interests.
The primaries are going to be really interesting, especially in New Hampshire, especially in Iowa, because if Nikki Haley gains traction, expect some of these people to really throw their weight behind her.
You've seen some of the numbers, Tom, that Ken Griffin's been putting into politics? Some big numbers, you know.
Oh, yeah. Yeah. I mean,
I think there were some people who thought that a lot of this financial backing would go to the governor of Florida, Ron DeSantis, and now we're having this conversation about Nikki Haley. That's a change in momentum that we've been talking about.
Oh, yeah, it's a change. But get the calendar
weeks
out. It's November, and this heats up. I'll leave it up to Amory Horton to tell us. But I'm sorry, it heats up February, which is almost on top of us. And it's like 2 months away.
Got the number for you.
2.5 months
Contributed almost $72.7 million during the 2022 midterm election cycle.
Maybe
based on our reporting,
Maybe he'll buy the New York Yankees. Joining us now on where we are after yesterday, a readjustment is in order. Subhadra Rajappa joins us now, head of U.S. rate strategy at Societe Generale. What did you adjust yesterday, Subhadra, in the area of 8:30 or through the day in your meetings at SocGen? How do you adapt and adjust to what we observed?
We didn't have to do much in our forecast because this was kind of what we were expecting, is a gradual moderation in inflation and for yields to gradually decline towards the end of the year and even beyond that. So this is very much playing into our narrative. It's really hard to know exactly which month shelter costs are going to moderate. We thought it might have been last month. It turned out to be this month. But the trajectory over the longer run is that inflation should start to gradually decline over the coming months.
Decline to what, Subhadra? This is sort of the key question at a time where a lot of people are pricing in significant rate cuts by the end of next year.
Yeah, no, core PCE maybe in and around 3.5% by the end of this year, and by 2.5% by the middle of next year. So the trajectory is for a very gradual decline between now and the middle of next year. But that should be sufficient for the Fed to adjust policy if they need to, given the fact that they've raised rates so aggressively in a very short amount of time. I think if they even cut rates a little bit, that's going to provide the support the market needs if there's a meaningful slowdown in the economy.
I think that the contrast between the slow, steady way that people talk about longer-term economic outlooks and the whipsaw, violent reactions that we've seen in Treasury yields is sort of an interesting divergence. What do you make of the fact that the economic outlook hasn't changed that dramatically from one month to another, and yet we see a 50 basis point swing in benchmark Treasury rates? What does that tell you?
It tells you that the market is paying attention to every word that's coming out of the Fed. After the FOMC meeting, Powell sounded a little bit dovish, which is not really the market's expectations. We saw this really sizable rally in treasuries. He then tried to walk that back in his speech on Thursday, which supported modestly higher yields. But you're also talking about an environment where liquidity in the bond market is extraordinarily choppy. And then add to that, risks associated with cyber attacks, and you see all of these very volatile moves in the bond market on the back of that. But I think we have to kind of take the signal from the noise, and the signal there is that the Fed is going to keep policy on hold, and yields should gradually decline over the next 6 to 8 months.
What will the inflation-adjusted yield do? I've got a real yield print this morning of 2.20. It was 2.16 in the enthusiasm yesterday, coming down, down, down. Does it drive down further through 2%?
Yeah, I mean, the real yield has declined quite dramatically as well. I mean, when real yields got up to around 2.5% in 10-year real yields, we kind of attributed that to the rise in term premium, more supply, the Treasury having to issue more coupon debt. And you know what? That scenario hasn't really changed meaningfully. And yet term premium has come down and real yields have come down as well. And I think that that's more the market trying to assess where yields should be from a fundamental basis. And given the trajectory for growth as well as inflation, yields should be gradually moving lower.
Subhadra, this big conversation now sparked really by yesterday's inflation print about rate cuts next year. Can we just sit on QT for a moment? What's your outlook for winding down the bond buying program at the Federal Reserve, pulling back on that balance sheet?
Yeah, I mean, I think that the Fed definitely wants to continue QT for as long as they possibly can. So to me, the debate is, will they continue QT when they're ready to cut rates? I mean, the market's pricing in for the Fed to cut rates as early as May. I mean, May meeting is fully priced in, which was kind of our economists' call for the timing of the Fed cuts. The question is, beyond that, do they continue QT? And I think our feeling is that they will continue QT in the background for as long as they can, which could be as late as the third quarter of next year. Then they might think about tapering or slowing down the balance sheet runoff, depending on how the economy does and how much they're going to have to cut rates. Because in some respects, cutting rates and doing QT are opposite, effects. So, we'll have to see how that plays out. But our call is that they're going to go on with QT at least till the third quarter of next year.
I'm really intrigued by the sequence of events as well around that. I know why they don't want to entertain it currently, but something to look out for maybe next year. Subhadra, thank you. Subhadra Japa there of SocGen. If you're just joining the programme, welcome. Your equity market on the S&P 500 is just about positive here, up nicely again by 0.4%. Yields climbing a little bit higher by 3 basis points, 448.24 on a 10-year. Just a monster turnaround in the last 24 hours. Yields aggressively lower yesterday. I want to sit on foreign exchange. The euro this morning, 108.55. We're pulling back some euro weakness. Yesterday, the dollar weakness. Yesterday was the worst day for the dollar for the whole of 2023, Tom. 12 months. The last 12 months. Been that bad?
It was there. I really looked at every single pair I got on the screen. I probably got 25 pair on the screen. And what was interesting, some things really moved and some things didn't. And it was interesting to see the euro move out to a 109. And also yen moved. I look at euro yen 163. But what was interesting off the grim GDP report that we reported out of Tokyo, I mentioned that earlier, the yen really didn't move all that much. I think Japan, I can't emphasize enough the shock within their system to what we saw, and yen didn't move.
Dollar yen right now, basically unchanged, TK. Yeah. Dollar yen at 150.47. Coming up a little bit later this morning, next hour, 8:30 Eastern Time, US retail sales is the next big data print of the week so far from New York City. This is Bloomberg.
The numbers have not been great. 0, 0.1, minus 0.1 quarter on quarter for 5 quarters in a row creates a little bit of anxiety over will this be a soft landing this stagnation of the euro area is, of course, a source of concern for all. It will help bringing inflation down, that's for sure.
ECB Governing Council member and Bank of Portugal Governor Mario Centeno there, speaking with our own Anna Edwards and Tom McKenzie a little bit earlier. Look at the scores right now in the FX market. The euro at about 108. Yesterday, that currency pair, the highest since late August, Tom. 108.54 on the euro right now, pulling back by 0.2%.
We are focused on the markets. There's no other way to put it. And of course, retail sales coming up here in less than 45 minutes. It's been an American discussion of the markets, and we've a bit taken our radar off of greater Europe. There's one note, just a few people, John, is qualified. There's Paolo Gentiloni. He's, yes, EU Commissioner for Economy, but John, he has lived the challenges of Italy. And we're thrilled that the Commissioner could join us this morning. Paolo, I'm absolutely taken by the stridency of President Lagarde of the ECB to get back to the comfort of a 2% ECB statistic, a 2% interest rate. What is the probability of doing that any time in the near future?
Well, good morning. According to our estimates that we presented this morning, we will be very near to this target in 2025, meaning that the pace of decline of inflation, which was very sharp October 22, October 23, will be a little bit slower in the coming year and a half. But we expect this decline to go towards 2% by the end of 25.
I look at the jumble and, of course, the celebration in America of successfully getting in trend disinflation, getting the vector moving in the right direction. John Ferro, my colleague, mentions the United Kingdom with a better disinflationary statistic. Can you say, not mission accomplished, but can you say you're going to see the same headlines in Europe soon?
Well, if we look to the last figures that we have for inflation, these figures were on October, and the inflation rate was 2.9%. If you compare this October to October 2022, they were at 10.6. From 10.6 to 2.9 is really a sharp decline. But having said this, we know that this was mostly determined by decrease in energy prices, and that so it was very much determined from the hikes in energy prices autumn 2022. This means that the path that we have ahead of us will be more gradual, but indeed I think that we are on track for this sharp reduction, provided we don't have surprises on energy prices connected to geopolitical evolution, which is our main concern.
Commissioner, can we talk about Italy specifically? You've got the deficit in Italy coming down to 4.3%, I believe, in 2025. That's different to the government. The government has a projection of 3.6%. Can we just start with what underpins that different projection from your side?
Well, we have different calculations. For example, we estimate in our forecast expenditure to reduce the labor tax burden that the Italian government has taken last year and this year and not factor in their forecast, but they announced that they will keep this measure, and so we have this factored in our forecast. So the difference is not enormous. One of the main factors is that we calculate this tax labor reduction, and they are not yet calculating it.
You have it materially above 3%, though, in 2 years. Can you help us understand, Commissioner, what happens if that number comes in line with your expectations? What happens?
Well, you know, we have fiscal rules, and we are discussing how to update them and to make them more efficient. But something that, in any case, will not change in the coming fiscal rules is the fact that we have a threshold for deficit, budget deficit at 3%. So we call to each government to reduce their budget deficit. Of course, we know these budget deficits are coming from the double shock that we experienced in Europe. First, of course, the pandemic, and second, and this was different from other regions of the world, the energy shock that we experienced last year. So we know where these high deficits are coming from, but we want to bring them down. And honestly, on average, we are bringing them down. The reduction of the debt at European level, 23 in relation to 22 was substantial.
I have to say, you sound sympathetic towards Italy's predicament. Commissioner, would you be advocating for a commission that was more accommodating of bigger deficits?
No, I think it's serious to have a reasonable threshold, 3%. By the way, in my own country, I had the opportunity to participate to 3 different governments and to lead one of them. We were always in the last 15, 20 years, apart from the COVID crisis, with a primary advance and below this 3% threshold. So I think the threshold is reasonable, is a common rule, and we need to go back to this threshold, of course, taking into account the extraordinary situation we lived in the last couple of years.
I want to finish up where we began, which is your new projections for economic growth, which were downgraded. And I'm wondering how wide the potential range of options are for your forecast if there is another cold winter, for example, if there is some sort of energy shock, or on the other hand, if we consider you to see oil prices where they are.
Well, I think we are better prepared than in the previous autumn. Previous autumn, we were indeed starting an uncharted world. We didn't know how. We had to cut the Russian gas, and we were uncertain on supply of energy. Someone was predicting blackouts, recession, etc. We didn't have blackouts. We have a level of storage of gas which is the highest in the last 10 years. And I think we reduced energy consumption. So we are better prepared than last year. Prices are much, much lower than last year, but they are still high in relation to the pre-war in Ukraine. So we had to address a difficult situation, but I have to say it's not so difficult as it was 1 year ago.
Commissioner, thank you for the update. We appreciate it as always. Paolo Gentiloni there, the EU Commissioner for the Economy. You have to think back 12 months. Going into last winter, Lisa, there was this real fear that Europe was going into a dark, dark place.
Yeah.
And quite literally as well, given the energy situation. Didn't materialize.
And now it's not really even in the outlooks that much. It's not the sort of fear hanging over everything. Have we really solved the supply chains with respect to natural gas, depending more on Qatar for some of the shipments to Europe? These are some of the questions I don't know if we've fully answered yet, given just how much of a question it was last year.
I'm going to suggest, as an amateur, that it links into retail sales here in 35 minutes and that try to get a plane seat to Milan. I mean,
it's
seriously,
expensive.
Try to get a plane
Tickets are
seat
going
to
down.
Milan.
Prices are going down.
Okay, they're going down maybe
a
for the first time, but I'm sorry. You know, Mr. Gentiloni's Italy is in a boom economy, and yet at the same time, there's this massive migrant debate.
I use my air miles, TK, to get to Milan.
I use my air miles to move children around. they're good at moving children around.
You use it to upgrade. Is that what you do?
Yeah.
Oh, nice, Lisa.
Vet bill's going to
Bramo
Vegas.
in business.
Hey? Bramo's large.
Occasionally.
Living it up, Lisa. There we go. Lisa's really spending. This is a turn.
She'll take the refrigerator with her.
A refrigerator.
No, hold on a second. I don't pay for it.
If you get another solid retail spending print, I think that's net positive for equities.
The American consumer does have the propensity to spend in the fourth quarter and into the holiday season.
If we lose the labor market, we lose consumers. If we lose consumers, we're done.
We just think that it's a market where you have to be nimble, you have to be reactive.
We don't think that we're in for a boom time in 2024, but we do think that the resilience we've seen can hang on.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene on radio, on television. Retail sales here in 30 minutes. Will it be the same festivities as we saw yesterday? John, it continues this morning. Pre-retail sales up 0.7% on the NASDAQ 100.
It's just been a phenomenal move on the S&P 500. Best day of gains since April across the board. You saw gain after gain. TK across the board. Every single sector in the green in yesterday's session. Small caps up more than 5%. Best day of the year. We talked about real estate on the S&P. Best day of the year. I hate to spoil the party, but this from Andrew Honhorst over at Citi. The reading does not change our view that underlying inflation is likely to remain stuck above 3%. In fact, he goes on to say the risks of sustained higher inflation rise with the reloosening of financial conditions. That last line on the reloosening of financial conditions. This is why I think a lot of people, Tom, inclined to say this market is declaring victory. The Federal Reserve will not. Because if they do, what do you do?
We're going to rip up the script right now. The Bramo cam is on fire. Lisa, please comment on the idea of what Jim Bianco and Dr. Hollenhorst suggest, a leveling here instead of the nirvana of to 2%.
It's how it happens, right? Is it a matter of the Fed having to do more to bring inflation down to that 2%? Or is this just, benchmark rate staying around 4% for a full year? It's a difference, right? The inflation versus the benchmark rates, and whether the Fed actually has to surprise with additional rate hikes. Right now, that's off the table. And I would imagine that the narrative shift would cause rather a shock in market pricing.
We're in data dependent in 28 minutes. Our team has really worked on equity perspective here. Yesterday was outstanding. Sam Stovall, truly a legend, and his family here. And we've got another winner on the bull market, Anastasia Amoroso, in a moment. John, everybody this weekend. I mean, come on, it's Wednesday, but we're rewriting for the weekend.
You're already
right
at the
now.
Weekend. Things are that good. You're skipping Thursday, skipping
strategists are at the weekend. They're ripping up their outlooks and they're ripping up their allocations, if you will, to get the next week.
David Costin and Goldman just published, looking for 4,700 on the S&P 500. Lisa, year-end next year, based on a move yesterday, we might get there this year.
Exactly. So at what point do you say, okay, we're baking in gains that are going to be had next year? And at what point are we saying maybe we're underestimating yet again the strength that we're going to see not only in the economy next year, but also in markets?
I want to get to the data check. The guest is so important because she nailed this bull market. John, I'm looking at the drawdown here, taking some of the details of the futures market with the S&P up 20 points. SPX from the, 18 months, 19 months ago, -6, down -5. But the NASDAQ has really come on. It was double-digit drawdown, now only -4%.
Big moves yesterday. We had some weight to this rally this morning. We're up by 0.5% on the S&P 500. Futures shifting higher in yesterday's session. Yields aggressively lower. 2-year out to 30-year this morning. Just a little bit higher, up by 2 basis points, but still sub 450 on a 10-year. 447.26. Lots of dollar weakness out there just yesterday. Bit of dollar strength against the weaker euro this morning at 108.65. That currency pair near the highs of late August after the worst day, Tom, of the year for the US dollar.
The grace of Bloomberg surveillance is we don't throw up films of people being wrong or people being right. This is a tough business, gaming out equities, bonds, currencies, commodities. If we tossed up a video, John and Lisa, of Anastasia Amoroso on the market a number of months ago, she held Lisa's hand and said, "Lisa, it'll be okay." The chief investment strategist
it wasn't cold and wet.
And correct bull joins us now. Is this the second bull market off the October lows 13 months ago? Are we clicking in with a new bull market lift?
I mean, I think this is giving investors a lot of faith and hope into the year end. You know, Tom, it's amazing how quickly things shift. And just in the last couple of weeks, we went from really bad technicals to really a great technical setup. And I think what's likely to happen now is the chase into year end is on. And it's going to involve a lot of stakeholders, whether it's the systematic traders, whether hedge funds that were caught too short, whether it's all the cash, $8 trillion of it on the sidelines. So I do think that I was initially going to say drift higher into year end. Based on yesterday, we might rip higher into year end, but I do think we finish higher.
Let's discuss what worked yesterday. Small caps, discretionary, real estate. Is that what you think works going into year end?
Well, I think tech is going to continue to work into year end because if you look at unprofitable tech, for example, it also rallied pretty massively yesterday as well. You know, the reason I hesitate when it comes to consumer discretionary, you know, I love the Target beat this morning, but it does feel like a bit of a one-off. And, you know, if we look at some of the surveys of consumer spending intentions, consumers are likely to be slower and likely to be more discerning, and they're going to want to look for promotions. So, you know, maybe this everything rally does take consumer discretionary higher with it, but from a quality perspective and where I have the most convictions on margins, on growth, on secular opportunity, John, I think it's still tech.
Okay, so how much is this baking in both the ongoing profits and also yields going lower, given that valuations are already pretty high, considering how high the alternative is?
Yeah, I mean, everything is working in the right direction right now. Clearly, this is a huge yield story. But when it comes to big tech, for example, you know, yes, yields help from the valuation perspective. But what I also like about big tech, for example, is that earnings growth is there over and above the S&P. For example, for the next year or two, the average earnings growth is about 16%. So, and by the way, valuations, I know people say big tech or tech generally is expensive, but when you adjust for that earnings growth, it's actually not that expensive. And when you start looking at individual stocks, maybe 40 times forward earnings on NVIDIA, maybe that seems expensive, but when you expand the chart, it's not actually off the charts, so to speak. So everything is relative.
What's the balance of risks? We've been talking about that throughout the morning for next year as people get enthusiastic into year end. Is it a better than expected economic picture, or is it some sort of recession that really feeds into a profit recession as well?
Yeah, so we have to decouple the view into year end versus what might happen in 2024. And I think the reason for this optimism for 2023 has been this is a soft landing year. This has proven to be a soft landing year. Now, I think something harder may have to happen in 2024. And here's really the big question, which is going to determine the direction of the markets in 2024, is how quickly does the Fed cut, or do they cut? If they cut, then I think we're off to the races, and, you know, this is the go in on risk moment. But if they don't cut, if they stay persistent, then I think some of the bulls may be disappointed.
Do we underestimate the ability of corporations to adjust? 24 months ago, I was screaming about that. We saw it with Target today. They've had a real post-pandemic challenge. I guess, John, what's it up right now? 42%?
It's up 13.25%.
Okay, 13%. Who's keeping count? But the answer is I still think it's underestimated in Fed-centric, rate-centric New York City that, I'm sorry, each and every corporation out there is going to adapt and adjust. What are they going to do next year?
Yes, corporations are adjusting, and in the case of Target, it took them a while, but those inventories were eventually pared back. I think what corporations may struggle with next year until and unless the Fed pivots is the refinancing bill of some of their corporate debt. And by the way, this goes across the spectrum. It's the U.S. government, which has to refinance about 35% of the debt between now and the end of next year. It's the commercial real estate operators that have to refi a lot of the debt, and then it's corporates. So, you know, the reason, Tom, why I think we haven't seen more of an adverse impact is because the percentage of floating rate has been low and companies have not had a lot of fixed rate maturities that needed to be refinanced. That does start to change next year. So if the Fed doesn't cut, I think it does become harder for corporates. And how do they adjust? Well, if margins get squeezed, I think cost cutting is the next measure.
Does that make life difficult for certain parts of the equity market, given the nature of high yield issuers?
Yeah, it does. The parts of the market that I worry about are leverage loans, for example, which have already had a full year of rates around 5%. And if you look at the net interest coverage ratios, they were about 3.5 times going into the year. For a lot of those issuers, they're one times today, maybe 1.3. So how does that picture change next year, especially if you have some slowdown in the top line? For high yield, I'm a little bit less worried because you do have generally higher quality and better fundamentals. And there's a small portion of high yield that needs to be rolled over next year. But from a broader economic perspective, and especially when I think about the banking sector, if you start to have more charge-offs, incrementally more delinquencies, some defaults, and by the way, venture capital bankruptcies have been on the rise. So all of that does start to impact some sector of the economy, which I think is the bank.
Can we finish on the banks? Kind of left for dead at times this year, and for good reason earlier in spring. What's your view on them into 24?
Very mixed view on them into 2024, because earlier on the show I did say that, I was kind of warming up to the bank sector because we were expecting the capital market activity to pick up. That really didn't pan out so far in the fall of this year, and I'm not sure that it does in 2024. So if you have lackluster capital market activity in 2024, and then on top of that, you do have those higher delinquencies, defaults, and charge-offs, that comes back to roots for the banking sector. So I appreciate the rally that they're participating in, but that would not be my top pick today.
You sound actually less optimistic than you did a bunch of months ago, quite a bit less optimistic. Can you frame that out, just how much you think some of the gains have already been baked in?
Yeah, I definitely sound less optimistic, year-end rally notwithstanding. And the reason for that is because a lot of investors coming into the year expected this to be maybe even a recessionary year, or at least very lackluster economic growth. And instead, we got close to 5% GDP in the third quarter. So a lot of people are now in the soft landing camp and are not even talking about recession. But if you think about this, the longer rates stay at the current levels, and by the way, if inflation falls and real rates start to pick up, the relationship we also talked about previously, then we are going to get in restrictive territory relative to the neutral rate. And that's when you start to worry about if the Fed stays there for too long, then that's what caused historically a recession. So I do worry about that, and I don't think it's in people's consensus numbers right now.
Is my takeaway here that Amoroso is on the edge of Bramo?
Open to a year-end rally, but maybe less constructive going into 24 seems to be the view.
It's going to be a long year of 24, so we can't just, prepare for the whole thing today.
Where's the joy that I heard 6 months ago?
Oh, the joy is here. The joy is into year-end, and, I do think that. Look, the Fed for now seems to be behind us until mid-December. I think some of the worst Fed Treasury auctions are behind us as well.
There we go. The auctions,
okay. So that's the joy.
The conversation begins.
The joy was on the screen over the last 24 hours in a major way. Anastasia, constructive so many times this year and right to be. Anastasia Amoroso of iCapital. If you are just joining us, catching up with us, your equity market's still positive, up by 0.4%. We are about 18 minutes away from US retail sales, the next big data point of the week following CPI yesterday. Amazing to see. Just a really small downside surprise on CPI, triggering a massive move in equities and bonds. Just the very definition of an everything rally. Equities rallying, bonds rallying too, yields dropping aggressively. That was yesterday. Lisa, this morning, yields up 2 basis points, a 10-year just short of 447.
And the why behind this, right? It wasn't that big of a miss or sort of a downside, right? This idea that something of a softening was a good news moment. It was that this was a market looking for some narrative, and it found one. And it could coalesce more concretely around this soft landing kind of feel. And that, I think, is what generated this incredible rally.
I think the business plan at Target today, granted, we're going to see the world's going to change here in 16 minutes. But the bottom line is corporations are adjusting, cutting expenses, last in, first out, and all the rest of it, John. The real nuts and bolts of business corporations are executing.
Certain days where you walk away from the price action of, say, a day like yesterday, where I spend more time thinking about the reaction to the data and not the data itself. That move was just phenomenal yesterday, Tom, across the board in stocks and bonds.
Triple leveraged all cash. I'm waiting for Walmart.
You're not rotating. You're waiting for Walmart before you rotate out of cash.
I'm not in rotation right now.
Okay. Well, Lisa's spending. Very constructive on retail sales, Lisa is.
Business class.
We're not not trying to decouple from China. But what we're trying to do is change the relationship for the better. From my perspective, if in fact the Chinese people who are in trouble right now economically, if the average if the average citizen in China was able to have a decent paying job, that benefits them and it benefits all of us.
A more constructive tone there from President Biden addressing the state of China relations before his trip to San Francisco, where he is set to meet with China's President Xi Jinping at the APEC summit a little bit later on today. Moments away, AMH on a West Coast this time. We'll catch up with Anne-Marie in just a moment. And also, in about 15 minutes' time, a little less than that, we'll get retail sales in America. The scores going into all of it. Equity futures look like this. We're positive on the S&P by 0.5% after a stellar day of gains on the S&P 500 yesterday. Higher by 1.43% on the Dow, Tom. On the S&P 500, up by 1.9. Yields are higher this morning by a couple of basis points. The 10-year TK, 446.28.
It's going to be interesting. We're 12 minutes away from retail sales. It's a nominal number, so if there is disinflation, if there is price decline.
We were higher, Bramo, by 490 points. It's a big deal yesterday. Good move.
You're going to let him do this? Yeah, how long is he going to be quoting Dow points? Seriously, is this a new thing?
It's a new thing. It's a new
thing.
It's a new thing.
It's a new thing. I'm becoming very mainstream.
Very mainstream.
It's a new thing.
Let's move on.
It's very good. Retail sales here in a couple moments. That'll be a really important review. Mike McKee, I believe, helping out this morning. She is in San Francisco, and for San Francisco, domestic politics is a spruced up the city. It goes back to the Moscone Center. She's outside the Moscone Center for this summit. Anne-Marie Horton joins us for the pageantry, the diplomacy today. Let's just cut to the chase. What's the schedule today, Anne-Marie? What should we wait to observe for? And at what time of day should we tune in?
Well, you're going to want to tune in later in the afternoon on the East Coast time, because that's when President Biden's going to be addressing reporters about this sit down he had with Xi Jinping. And yes, I'm in central San Francisco, where you see heads of states descend on, CEOs descend on for these meetings with Xi Jinping and also the broader APEC summit. But more importantly, the estate is gorgeous, where President Biden will be sitting down with Xi Jinping, and that is south of San Francisco. So the everyday onlookers here are not really going to be able to get a sense of Xi Jinping and President Biden in San Francisco, because they are moving that out of the city, obviously for safety concerns, but also to, I think, evoke that vibe that we saw when Xi Jinping visited President Obama, also on the West Coast. And it was supposed to be a little bit more of a relaxed environment so they could really get to work and have a serious dialogue and frank conversation.
Anne-Marie, the president will enjoy his 81st birthday here on November 20th. Truly, of our politicians, he and a select few have lived the permutations of this relationship. How does the White House perceive Xi versus the history of China?
Well, this White House wants to get this relationship back on track. Obviously, Xi Jinping and President Biden are walking into this meeting after a year of true acrimony between these two individuals. At this moment, one of the highest priorities for the White House is just to get basic military-to-military communications back to a normal cadence. And that's really what President Biden said yesterday before he departed the White House, before he came to San Francisco. He talked about the fact that he just wants to get back to this relationship. We don't want to decouple, but they want to set ground rules. The issue right now, what they're dealing with, and the president gave a little bit of a poke there to Xi Jinping and what's going on in his economy. He talked about the fact of the matter is that in China, the economy is struggling right now. And that's the China they're dealing with, an economy that is struggling, but a Xi Jinping that many critics are very concerned with is moving into and becoming a little bit more of a hawk when it comes to the military side of the CCP.
Do we have an understanding, Anne-Marie, of who's going to be attending the CEO dinner later tonight with Xi Jinping and what the tenor of that's going to be?
Well, I think a lot of people at the moment, we don't have a full list of who is attending that dinner. We don't know who's going to be here at the summit. Likes of Jane Fraser, Elon Musk, Satya Nadella. These individuals likely are going to be sitting down with Xi Jinping. There's also almost seems like two dinners happening, a bigger one where Xi Jinping will be meeting a lot of people, and then a smaller one that can have a bit more frank conversations with chief executive officers. And really, China wants to make clear when Xi Jinping meets with these CEOs today, they want to assuage those concerns that China is open for business. China is investable. And I go back to the comments that Gina Raimondo, the Commerce Secretary, made in August. She talked about the fact that businesses continuously tell her that they're nervous to invest in China and that, quote, China is uninvestable. For Xi Jinping, that is very worrisome. And that's why the CEO dinner and these meetings are incredibly important for him and his economy.
Janet Yellen's dinner was something of a subject of discussion, including your own reporting, as she was seen getting a cheeseburger with onions and fries and a Diet Coke at an In-N-Out Burger on the way to the airport to meet Xi Jinping. What's her role in this, given that she did meet already with top-level officials from China and laid the groundwork for what we're going to hear possibly later today?
I have to say, that's some of the best reporting I've ever done. Be able to understand what delegates are eating before they meet world leaders. And by the way, that stop was totally impromptu. It wasn't scheduled as a PR stunt. She was on the way, she was hungry, and she says, I want a burger. And if you live on the East Coast, it's one of the first things you do when you get to the West Coast. But in all seriousness, China sees the Treasury Department as a serious broker and a way and a path forward into this relationship in Washington, D.C. It is likely why the Biden administration sent Treasury Secretary Janet Yellen there. She obviously went to Beijing. She had that first meeting here last week with her counterpart, and she's been setting the groundwork for the meeting that is going to happen later today between Biden and Xi Jinping.
I have been to the LAX In-N-Out, TK. It's a good one. I've been to that one, that particular location.
Same. It's like Ben's Chili Bowl at Reagan.
You're saying they're different in different places?
They're different. Airport, it's not the same.
He's done the tasting tour.
You know, I sometimes I can't get up to U Street.
I've gone to another In-N-Out outside of LAX, TK, and it was pretty much the same. What are you talking about?
You know, I just think, you know, I mean, AMH, they could go to one of the great diners in San Francisco with Yellen and chow down. I can see it, you know. I mean.
Okay. All right. MH, thank you. Tremendous reporting, yeah.
Yeah.
Anne-Marie, on the ground on what Secretary Yellen had to eat.
She put that on the Amex.
To be clear, I think the challenge in front of Xi Jinping today is incredibly difficult. I think it's a really, really difficult needle to thread for the following reasons. He can only control what he can control. And there are some things that he can do to make it a more predictable investment environment for corporate America. And certainly he's disrupted that in the last 24 months. I think a lot of corporations would point to some of the moves they've made that have made it much more volatile and unpredictable, without a doubt. But at the same time, Lisa, he also needs the United States to play along. And I'm not sure the direction of travel for this relationship changes today in any way, shape or form. I think today is about just dialing the temperature down, just playing happy families for a little bit. But are we ultimately heading in the same direction? I think so. And for that reason, there's a lot of corporate America who have looked elsewhere. This whole deglobalization, pick your word, I don't really care what you use, but ultimately friendshoring, nearshoring, Lisa, that's been the direction of travel now for the last few years.
How do you give people a sense of policy security where there's been none? Right? There's been no sense of exactly how the relationship between the U.S. and China will really evolve, given some of the discord over the past 24 months. So given that, what can they say in one make-nice meeting that's going to alter businesses that have to have risk scenarios and the businesses that were really dependent on China before, looking increasingly long-term to diversify?
Sure.
I would defer to Enda Curran and Steve Engel on this, and I think the great unspoken here is those executives saying, what did you do to my Hong Kong? Every multinational American corporation has some form of entrenched relationship in Hong Kong that's been blown up.
Tom, they're petrified of talking about it.
Every single chair.
Petrified.
It's what we're talking about, they can't talk about.
Yeah, they don't want to talk about it at all.
Can't talk about it.
That's where the situation is.
But they've been blown up.
Oh, without a doubt. Without a doubt.
No question about it.
What can you change here? Maybe you can say, yeah, we'll commit to doing some more business, but the data point that stands out for all of us in the last few weeks is foreign direct investment into China turning negative.
Right.
Tom, turning that super tanker around is going to take more than one meeting on the West Coast.
Well, yeah, and again, the idea, I'm looking as a surprise here, some form of discussion on tariffs, but that goes back to domestic U.S. politics.
U.S. retail sales coming up next. Stay tuned for that. Equities are higher going into it. And the next hour on Bloomberg TV, Vishy Tripatura of Morgan Stanley, Evercore's Julian Emmanuel, Marilyn Watson of BlackRock on the everything rally of the last 24 hours from New York City. Good morning.
Bloomberg Surveillance, Lisa Abramowicz and Tom Keene. We've been looking at the Abramowicz spending pulse here into retail sales. The measurements of consumer, fascinating right now, particularly after what we saw yesterday.
And particularly the breakdown. The key question for us is also how the market is really going to respond to some sort of upside or downside surprise, given what we saw yesterday, Tom, given the incredible rally in bonds and stocks.
It's going to be interesting to see, and then to follow on to Michelle Meyer with her expertise at MasterCard. That will be something. Right now, out of control with the control group, Michael McKee on America's consumer and retail sales.
Well, sales are a little bit better than anticipated. We'll have to see what the breakdown is, but retail sales headline comes in down 0.1. That is much worse than last month's
up
0.7. Actually, last month revised up to 0.9. Remind me, I got to tell you something about that in a moment, but the forecast was for a drop of 0.3, so that's good news. Take out autos and gas, and you're up 0.1. And retail sales control that Tom just mentioned, essentially the stuff that goes into GDP, is up 0.2. That's down from 0.6 in September. PPI is out, and it is deflationary. Headline falls by 0.5% after being up 0.5% in September. The core rate, which I put the trade number into as well, is at 0.1 after 0.3 the prior month. So we're seeing some significant revisions to the PPI numbers in the past. And then year-over-year basis, headline 1.3 and core 2.4. The Empire Manufacturing Index turns around, goes up to 9.1 from negative 4.6. So a lot to digest there. The one thing that I wanted to mention about the retail sales is that because they're so heavily revised and they come out halfway through the month and they get a lot more information generally, and I would assume that the distinguished gentle lady sitting across from me will be able to expand on this. You try to look at more than 1 month in a row and sort of average out where we are. So you look at 0.9, the revision up, and 1/10 lower, and you're looking at still a pretty good couple of months of spending. And all of this, obviously, impacted by gasoline prices, and it's all price-based. So.
On first blush, the markets look up and even up more than before, but then they give it back here, pretty much level now. It's Dow 35,000. Futures up 19. They were up in the 20 level earlier. Dow futures up 112. The VIX 14.19. And Lisa, yields pop up a little bit here. It's not the 19 basis point yield frenzy we saw yesterday.
Not to be too speculative about knee-jerk moves up and down, but when the first numbers came out and it was retail sales coming in pretty much in line, if you take a look at the main control group, PPI deflation outright, yields plunged, right? Bond rally. Then you look at the revisions of retail sales. It was revised upward one read after another in the prior months. You average these out, people are still spending, Tom, and that to me is really the key question behind some of the disinflationary narratives.
Michael McKee, is it too early for you to parse 15 pages of data and say what Amazon did? Do we know this online juggernaut?
Non-store retailers were up 0.2%. They're up 7.6% on a year-over-year basis. So people still spending some money there. Obviously, one of the bigger losers was gasoline, down 0.3, which is a little bit less than I would have anticipated, given that retail gasoline prices fell by about 10% during the month of October. Clothing and accessory stores flat. Maybe that's not a surprise after everybody goes back to school shopping in September. Sporting goods, hobby, musical instrument bookstores, the big loser, down 0.8%, along with furniture and home furniture stores down 2%. Motor vehicles, we knew unit sales had dropped, and you throw in parts and service and you get a drop of 1% during the month. Food stores up 0.6, grocery stores up 0.7, and health and personal care stores, I guess Tom got a haircut, 1.1% gain.
Lisa, this is important to bracket these two reports, folks. Lisa, roughly 5.04% 2-year. Massive lower yield, way through 5%, 4.XX, and we've come back 4 basis points to 4.88%. So after these two reports, it's still a huge yield shift.
Which raises a question, doesn't this just confirm the Goldilocks nirvana that we had yesterday, where basically we're seeing retail sales continue and disinflation or outright deflation in goods also continue, Mike?
Well, obviously, disinflation plays a role here because prices, this is all price-based. And so the fact that we have seen a decline in overall prices is going to subtract something from retail sales growth. I think the report kind of gives you something for both sides. If you want to say that the economy is slowing, well, 0.2 is significantly slower than 0.7 for the control group. If you want to say the economy is growing, it's still much better than anticipated, and we're still seeing strength in a lot of different categories. We do have to be careful, Tom, in how we analyze this, though, because Lisa only bought her refrigerator this month. So it doesn't show up in the appliance store sales.
Oh my God,
that were up 0.6 this month.
Talked about refrigerator ever in the history of refrigerators. No one needs to hear, Tom, anything more about this refrigerator. Carry on.
The Dolce & Gabbana $55,000 smeg. Michael McKee, don't be a stranger. Stay with us and continue to dive into the data. This is a joy. What happens with young economists is you read their research and you go, oh, they're quite competent. Not long ago and far away, but a few years ago, that was Michelle Meyer absolutely owning the parsing of the American consumer. She worked for a small bank in Manhattan and is now chief economist North America for MasterCard Economics. You own the analysis. I put you and Ellen Zentner together. You own the analysis of the American consumer. Have we stopped spending?
We clearly have not stopped spending, far from it. I mean, think about the data this morning. It was an incredible combination of continued strength in retail spend, a rebound in Empire State manufacturing, which shows that there's still a need for more goods production, which is because consumers are still spending. And on top of that, you're getting some relief on the pricing side. So it's a really nice combination.
I hate asking this question, and I'm stunned. It's my first time I've asked it on November 15th. What's the holiday season look like? What's Black Friday and then Black Monday and this and that? What does this retail madness to January look like?
Well, it is a longer holiday season. We've learned that over the last few years. And it's a heavily promotional-based holiday season. And part of that is because of the fact that there's so much demand out there to buy online. I mean, think about the numbers we just saw this morning. Our spending pulse numbers saw just over 8% year-over-year growth in e-commerce sales. So, you're seeing a consumer that is certainly exploring many different channels of spending, including online, and that creates a lot more opportunities for them to get products. And it also creates a lot more need for retailers to compete with these big moments in time where they offer promotions. And I think that's what's going to be indicative. So we'll learn a lot from the Black Friday period, and it's approaching very quickly.
How sustainable is this combination of both robust retail sales and disinflation, or even outright goods deflation?
So I think you have to consider the different categories. I mean, when you looked at CPI yesterday, you certainly saw some categories like these big durable goods, like your refrigerator, it's back, seeing some price declines. But for many other things, like many services, for example, you are still seeing some price increases. So part of the drop in prices for some of these goods simply reflects the fact that prices increased too much coming out of the pandemic because of supply chain issues, because of higher costs. And now it's reverting a bit more to something more normal, right? So that means in real terms, you will see some support in terms of some of these items moving through. In nominal terms, you could see some move down in terms of overall spend. So it really depends on why inflation is moving, and that is a function of the type of product and how things evolved coming out of the pandemic.
When you put it together, does this seem like a recipe for this Goldilocks soft landing, or does this seem to paint the picture of a Federal Reserve that needs to do more and of an economy that has way too much momentum to really achieve the disinflation that a lot of people are baking into market valuations?
I think the data is shaping up in a way that's really favorable at the moment, because you continue to have economic growth. Look at the third quarter GDP numbers. That was fairly broad-based economic activity, not just consumers, but also businesses investing, inventories getting much more manageable and in stock. So things have been evolving remarkably well in terms of the real economy taking out some of the excesses, labor market coasting into a little bit of a slower trajectory for job growth, but still expansionary, while you get this relief on the inflation front. So how much of that is because of monetary policy? How much of that is because of the nature of the shock that we had initially? We'll see. It's probably a bit of both, but it's evolving really quite nicely, and obviously exceeding many people's expectations out there.
We talked about the interest expense and the debt and the deficit earlier with Maya McGinnis. Let's talk about the average charge card is 25-26% interest, migrating up now to 28-29% interest. I find 30% to be almost criminal, but you people look at this daily. Is that interest rate goes up, do we spend less?
So what we're looking at overall is how monetary policy is transmitting into the economy broadly. So when you think about who's borrowing out there, there's companies that are borrowing in terms of their expansionary needs. There's consumers that are borrowing in terms of whether or not they want to buy a home or a big ticket item that might require some leverage. So higher interest rates are certainly transmitting into the economy. You can see it today with the retail sales number that Mike just referenced around housing related items, furniture, some of these bigger ticket items that require debt. You are seeing some hit to those types of spending. So I think the high level of interest rates goes back to Lisa's point around how the Fed is trying to calibrate this economy with some easing of real growth, but still allowing inflation to come down.
Okay, you're out of the game, but I'm going to ask you the game question here, which is what is your 12 months forward real GDP? Like, what's your 2020? You're talking to fancy people at MasterCard, and they don't want to know about charge cards. They want to know what Michelle Meyer thinks about the economy. What's your 2024 real GDP call?
So the good news is that I'm still in the game in that we are still running our forecasts.
Daily?
We're still, absolutely. That is who I am as a person, as an economist. When I look ahead, I mean, this year we had an economy that ran above its underlying trend. So we're trending right now, given where GDP is, for real growth somewhere between 2.4% right now in 2023. As we look ahead to 2024, we're probably going to see some moderation closer to the underlying trend growth rate of the economy.
Sub 2%?
Closer to trend.
She didn't answer me. See, she's still in the game.
I'm still in the game.
I got the total Michelle Meyer nodding and said, go away. Michelle Meyer of MasterCard there in their Economic Institute, which is brilliant work. Yes, it's linked into the charge cards and the damage we do, but it's also about the greater economy. Futures, they've got back a little bit. It's not the festivities, the addiction of yesterday. I want fireworks.
Let's go through it. The S&P up by 0.3%, so still solid on the day. Tom, I do want to bring this to you, just crossing the terminal, that SpaceX is discussing an initial public offering for its Starlink satellite business. It's been in the news quite a bit about providing reception satellite operations for a host of different countries. It could come as soon, this IPO, as 2024. They're already laying the groundwork for it in terms of isolating some of the resources into a separate unit. A lot of questions, though, here about how this will potentially percolate out.
Well, yeah, it's just a ton of satellites up in the air, right? I mean, essentially, it's taking the internet in orbit. It's just that simple.
He dominates it, right? And he's been in the focus very much of who he provides Starlink access to. It's been controversial and also highlighting just how strong his presence is in terms of global interconnectivity. We will continue looking through as we get more details, but I just wanted to bring that to you. Just on the retail sales, to me, again, it just sort of permeates this feeling that we're heading toward a really good setup, Tom, heading into next year, with people kind of pushing out that recession forecast even
pushing,
a little
I'll
bit
say,
further.
Big time pushing out. There's no question about that. And I go back to the arch difference. We did not talk to Michelle Meyer about this, but the basic idea of when does this labor economy break? And that's a recalibration we have to make in the first week of December.
If companies are still investing, people are still buying, what's going to be the trigger, right? I mean, you're not seeing it in earnings. Margins are coming in better than expected at company after company.
We'll have to see. We're going to go to break here. Michael McKee is with us, and he will dive into this through the morning for all of Bloomberg Radio and Bloomberg Television. Futures up 20, now up 11. Stay with us. Bloomberg Surveillance.
that resilient growth story can run. I don't think a recessionary threat is immediate as we look to the first half of next year. And as I said, with rate hikes in seemingly behind us, that can support momentum, along with like a reasonable amount of cash on the sidelines looking for a home.
And maybe they're finding it in risk assets this morning as well. Ben Guterich, investment director at Invesco Investment Solutions, earlier this morning talking before we got that retail sales report tied with the PPI data that came out and continued on this feeling of Goldilocks that really has permeated throughout markets so far this week. Tom, we still are seeing a lift to stocks. Bonds a little bit softer here. Yields up on the 10-year, up 6 basis points.
Fascinating to see how we open here. We're going to do this in 45 minutes. It's going to be after what we saw yesterday. I love what Rabila Farouk wrote up at High Frequency Economics on retail sales. She says, the fact is they're really good. And there's this one phrase which goes back to the arch debate of Monday, which seems ages ago, a still strong labor market. And again, all of this Fed analysis is centered around not rates, but what does the American job economy do? And
the economy,
Farouk's making clear it's a still strong labor market.
The economy is still holding in. Just want to take a look at some names that are highlighting that point this morning. We did get earnings from Target as well as TJ Maxx. Tomorrow we get Walmart results. What I find interesting is where the bar was set going into this. Target outperforming, talking about better than expected third quarter earnings, showing inline expectations for earnings, but also just inventories coming down 14%, really highlighting how much they've turned that story around, up down 14% those shares.
I did not know this. Target, PE, 15. Walmart, PE, 31. I had no idea the premium of Walmart to Target.
It's been a massive underperformance for Target. We're getting that back maybe a little bit today. TJ Maxx, a bit softer after giving guidance that was underwhelming, talking about not necessarily upgrading how much they expect sales to increase despite the active sales forecast that we just heard from Michelle Meyer there, Tom.
Well, see it. What's great about this is we don't talk to Sowerby until the Russell goes up 5%. I mean, that's all there is to it. You don't talk to David Sowerby and you get a true jump condition.
So let's get there right now. David Sowerby, portfolio manager and managing director at Ancora. Are you buying the Russell this morning? Are you seeing Goldilocks and rainbows and lots of wonderful things that give you lots of confidence?
Lollipops and puppies too, Lisa. It's not just that small caps can rally, but large caps can too. Tom and I had a conversation about 10 trading days ago on the radio, and I made the reference that if Jay Powell is the head lifeguard blew the whistle, get back in the pool. You had likelihood of less Fed tightening, pausing. Sentiment, unusually bearish. That's a good contrarian indicator. And out of third quarter earnings and cash flow, that's been very good. Margins, free cash flow margins, 11%. That's above average. And companies are growing their dividends better than 10%. You're never going to get all the stars aligned. Nevertheless, blow the whistle, back in the pool, be a net buyer.
David Sowerby, the fact is, when they move, they move. In 2003, 20 years ago, Russell 2000 up something in the vicinity of 40, even 45%. Do you suggest we could see that, given this titanic shift in rate and inflation belief?
I think the relative performance of small caps to large caps sets the table that small caps can meaningfully outperform. You've got valuations at roughly the same levels I saw in early 2000 when small caps were on their back. People were saying, why own small caps at all? I can own large caps and maybe alternatives like private equity instead. And yet small caps delivered for an extended period of 5 years or longer. So I think that the setting is very good. And the real key was interest rates peaking and starting to decline.
Right.
That's been the real catalyst for the small cap move recently.
Is there a magnificent 7 in mid caps? Forget about the small caps, but in the sort of kind of like caught in the middle, almost large caps. Are there tech type companies there?
Less so. You don't have, out of the 2000 and the Russell 2000 index, we know more than 30% of them don't make money, but you still have a pretty robust fishing hole to be buying stocks. So today is retail day. Let's talk about two small cap retail stocks that look appealing. One is Vera Bradley. They make handbags, home accessories, luggage. They've got no debt, generating very good free cash flow, buying their shares back. Only 2 analysts follow this company. You've got a better opportunity to find value when you've got fewer Wall Street analysts than more. So that's one example. And if you move to the fast casual dining space, Potbelly is growing their free cash quite handsomely. Also very good balance sheet. It's quick service sandwiches. They're growing their stores more than 10%. That's good unit growth. Those are two good small cap names to keep your eye on, knowing that there's no Bloomberg Magnificent 7 among all the small cap stocks.
All right, let's talk about some of those small cap businesses and just how rates higher for longer will affect them next year. If, let's say, the strength that we're seeing in the retail sales, yes, we are seeing disinflation. If we see rates staying around here, how much do these companies get really squeezed by the fact that any kind of downturn in sales, they can't borrow to offset that without paying a punitive rate? They can't necessarily hire cheap employees because the salaries have gone up as much as they have. How squeezed are they in the face of any unexpected weakness?
I think whether it's small cap or large cap, the higher interest rates posed an element of squeezing. So when you have so many opportunities to buy in the small cap space, much like their large cap siblings, they were able to extend their debt to move from floating rate to fixed rate debt. That's a very good move. And you've seen that prevail not just in the large cap, but in the small cap space, where so often we just pay attention to the income statement, earnings per share, really focus on the cash flow statement and the often forgotten in the trinity, the balance sheet. And if you put those two together, you can find very good opportunities in the small cap space where you have the potential for double-digit returns in 2024.
David, what is the efficacy of active versus passive index in mid-cap? Is it worth stock picking, or do you just buy the given mid-cap ETF?
Tom, you'll never hear me say the overused phrase, it's a stock picker's market. However, my parents raised me, don't play for a tie, be an active stock picker. And whether it's large cap or small cap, you can buy a small cap portfolio of 50 companies, be very well diversified, not the whole 2,000, especially given so many companies are not profitable. It is a better backdrop to be an active investor, given breadth is going to widen out in the market, and that favors the active investor versus the passive investor, without talking my book as an active stock.
Well, you are. You're talking your book. Thank you, David Sowerby. Thank you so much. My senior executive, Starlight producer Qantas, says, Tom, we got to talk about Apple now. Too much mid-cap chat. David Sowerby, expert on mid-caps and small caps as well. That's such a pleasant relief from our total fixation on what, 15 stocks, 20 stocks?
Those stocks have driven everything. And what a lot of people are saying is they will probably continue to into year end. I just want to note something. There was a shift today, a slight shift around the margins, not like yesterday, which was much more dramatic and much less nuanced. But there seems to be a little doubt creeping into bond markets as stocks cheer.
Back 5 basis points.
A little bit of doubt about whether the Fed really has won this, about whether inflation really is gone. And you could see no rate cuts being priced into the meeting for the remainder of this year. And now rate cuts are slowly being priced out along the curve later next year.
I agree. There's a real subtle dynamic off these two shock reports. We're still up 17 on futures, but we're up 20, even 25 earlier. Dow futures well over 100 points, now just up 88. But, you know, there's a lot of soul searching going on. You know, we make light about it. We make jokes here to keep the coffee going. The Sanka this morning was awesome. But the fact is, this is really serious stuff. And there's a lot of global Wall Street people whose jobs are in jeopardy because they were some relative of caution or even gloomy. I mean, what happened yesterday is a serious thing to people's livelihoods.
We are seeing the Goldilocks transpire that people said was pretty much impossible to achieve. The data is suggesting that is what is actually happening. Whether it's a moment in time or whether it's something that is sustainable is really the unknown. Can we get strong sales and disinflation for the foreseeable future.
The data check into the close here, up 16, Dow futures up 82, the VIX 14.19, as Lisa mentions. Yields higher off the stunning moves yesterday, 4.49% in the 10-year yield. Really can't say enough about the coverage the last couple days. Mohamed El-Erian scheduled Friday. Good morning.